So those are your stocks to watch this Tuesday. A bit of a mixed picture on the earnings front. Kriti.
Yeah, it's a really interesting dynamic because we're talking about that weakness or potential weakness in the States mirrored with that potential strength in Asia. And how does that kind of sort out? And I think the companies you named are such great examples of really diving into that. When it comes to the market open, we are getting those numbers out just right now. You are seeing the FTSE 100 open a slightly negative territory, I think we're going to call. We are still waiting for the others as well. But I think that earnings picture is really going to change the dial, specifically when we get those opening trades around oil, not just in the UK, but over in France as well. Remember, Total is going to be affected. Are we going to see a rebound in the luxury sector? How do the drink makers perform? Tom, you and I had that conversation just yesterday with likes of Heineken, for example, talking about that major hit. Do we see that same hit show up in the Diageo numbers, given that weakness that we saw already? Some of the numbers coming out, it's a similar story to what we saw in futures. We're green on the screen on the continent, underperformance in the UK. You're also, by the way, seeing a little bit of outperformance in Spain as well, specifically because we are seeing those numbers cross the wire at the moment. CPI GDP coming in a little bit hotter, Tom.
This looks like a Goldilocks print for Spain, though, and at least the ECB, because the second quarter GDP is a big beat for Spain. As you said, 0.8% is the number that we're getting for Spain. And in terms of CPI, so inflation coming down to 2.9%. The estimates had been that you'd see an increase of 3.2%. So you're back below 3% in terms of July harmonized CPI. This is prelim for Spain, and that's year on year, 2.9%. The estimates have been for 3.2%. In terms of GDP, as you say, pretty decent number coming through for Spain, 0.8% quarter on quarter. The estimates had been for just 0.5% of growth. So let's see how that ties into expectations around the ECB. That looks like a pretty decent set of numbers in terms of inflation going lower, growth going higher for Spain. In terms of those individual stock moves, we're looking, and we'll take a look at sectors as well, because interesting stories, of course, coming through from BP, Diageo and Standard Chartered. We'll break those down for you. But on the sector moves, let's have a quick look then in terms of how things are shaping up. It was autos that was near the top yesterday, and travel and leisure also doing fairly well. Commodities, basic resources are in focus for us today. That is the biggest loser, down 0.8%. Basic resources. That is going to be a drag on the FTSE 100. We've seen the softness. In fact, the Bloomberg Commodities Index has erased all the gains of the year, Kriti rightly zeroing in on the softness around the oil price, and a lot of this is going to be blamed on China. Iron ore in the session is down 3%, so the FTSE 100 currently down 0.1%. As the futures have suggested, it is the outlier in a picture that is otherwise very, very modestly positive in Europe.
It's an interesting one, especially because, to your point, you mentioned kind of the banking story as well, but some of the outperformers in the stock 600, you're actually seeing show up in the tech space. The fact that ASML is outperforming ahead of the fact that we're getting Microsoft numbers tonight, I thought is very fascinating. And is that actually a little bit of a move towards a defensive story? We were talking earlier with the head of trading out of Neuberger Berman as well about simply that rotation trade, maybe hitting a little bit of snafu. Look at your outperformers this morning. It's basically all the ones on Guy's Sensational Six. The mega cap stories of Europe seem to be the outperformers of today in alignment with some of the European earnings stories as well.
Yes, it's taking the baton from a more positive picture when it comes to the big tech names in the US, led by Tesla with the upgrade coming through from Morgan Stanley. Stanley, Tesla shares ending up around 5% higher by the end of the close yesterday, but more broadly as well, gains coming through for tech. So to what extent is that rotation theme now being challenged? When it comes to Diageo, we are, of course, looking for that company. The print hasn't come through yet for Diageo, but it was a miss in terms of the earnings, with a particular concern around the LATAM part of the business. Let's bring in the CEO right now. Very pleased to say we are joined by Diageo CEO Deborah Crew for the details on this. Deborah, good morning. Thanks for joining us. Walk us through the challenges facing the business and how these numbers set you up for the quarters ahead.
Yeah, so our fiscal year, we ended with our net sales declining 0.6%, and that was really driven by our Latin America region. For perspective, if you back out sort of Latin America results, the rest of the group performed and grew plus 1.8%. It was no doubt a challenging year. It was a challenging year for us. It was a challenging year for our the industry in total. But I am pleased that as we moved through the year and as we got into the second half, we really picked up share momentum and ended the fiscal with either holding or gaining share in markets that represent 75% of our net sales. That includes markets like US and China. And we also delivered a record year of productivity, plus $700 million. And that helped us to deliver great free cash flow, $2.6 billion. That is up. That's an improvement versus prior year, despite the softer top line.
Are you seeing, Deborah, on the US component, are you seeing a reluctance from US consumers to spend and spend big on those premium products that you offer?
Yeah, we are faced with a challenging US environment, just like many other consumer facing companies. We're calling it a cautious consumer, a U.S. consumer that's quite cautious in spending. Wallets are under pressure as inflation is persisting. You're seeing, 30-year high grocery, food basket prices, and that has certainly impacted us. Additionally, interest rates remain high, and so that's impacting retailers. We've had some retailer destocking this year. But as I mentioned earlier, our brands still in this environment. We do see consumers willing to spend when it's really important for them. That matches well with our, with our celebrating, gifting, that type of area where we have, and we have picked up share. We in fact ended with gaining or holding share in 90% of brands that represent, well, actually of brands that represent 90% of our sales. Brands like Don Julio, which is a super premium tequila, plus 12%. Brands like Guinness, plus 6%. And these are premium brands. So, in the right occasions, we're seeing it, but certainly wallets are under pressure, and it has impacted us.
Deborah, as we're speaking to you, we should just mention for our global audience that Diageo shares are officially open. You are seeing the shares drop by about 6% in the opening trades here in London. I want to pick up on the concept that you're just talking about, that weakness that you're seeing in the States. How is Diageo combating that? Is that in terms of strategy, are you looking to boost volume or are you looking to boost price?
Yeah, so look, we are navigating through this, and we're a resilient company. We've got great global iconic brands. So we are going about, and we're very much on our strategy, our long-term strategy, and it is about continuing to gain quality market share with our premium brands. We are also really raising the bar on execution. Orienting our commercial resources against those pockets of growth, because there are pockets of growth out there. I mentioned Don Julio earlier. I mentioned Guinness. We've had some great innovation plans. We've launched Crown Blackberry. It's a more premium but much more affordable whiskey brand that we've launched a Crown Royal Blackberry that's done incredibly well. Yeah. We've done a cocktail collection. So we've done a lot of innovation that has really helped us. So we're focused on those pockets of growth. We're focused on operating with excellence. And when the consumer environment improves, we will absolutely return to growth.
So, Deborah, speaking of those pockets of growth, one of the tailwinds, or one of the growth areas for Diageo has, of course, been Latin America. And it seems like that's where not only are you seeing pain, but you're seeing some inventory issues as well. Walk us through how you're combating them. Yes, it's not as key of a market for you as the United States, but it is still one of your big growth areas. Walk us through the Latin America story.
Yeah, well, as we talked about at the interims, coming out of the pandemic, this is a long supply chain, and so we had built up, supply that was really more for that kind of pandemic era where we had a super cycle. And so we had extra inventory in, it's about a 6-month supply chain, and so we built up inventory, and the market conditions really deteriorated quite quickly. We talked about this at the interims. We committed that we would work through that within this fiscal year, destocking, getting better visibility on what we had in the various channels, and and absolutely getting to a place where we would get to more appropriate levels for the current consumer environment, and we have done that within this fiscal. We're much more set up for aligning our future performance with that consumer demand, and so we've worked our way through it.
Deborah, more broadly across the portfolio and across your regions, when does that consumer demand come back in a meaningful way?
Yeah, I mean, look, there's a lot of uncertainty out of there, and it's a very cautious consumer. We're navigating that, throughout the world. But that being said, we are focused on the things that we can control in this environment. We are resilient. We're strengthening the resilience of the company through our margins. That's why we got very focused on productivity. And those type of moves, delivering great cash, but also really making sure our brands are set up.
On the margin story, Deborah.
Yeah.
On the margin story, would you consider discounts, price cuts?
Well, we're very surgical about how we do, pricing. We have a broad portfolio and brands that are positioned across the different price ladder. So, as an example, in Europe, what has really helped us is a strong Johnnie Walker Red business. It's a more standard, priced Scotch. And so that's really enabled us to weather some of the down trading that we've seen on Scotch in Europe. In China, our Baijiu business, we're one of the few Western companies in Chinese white spirits. We grew China plus 12%. That is it's a more affordable kind of in the Baijiu segment with our Shui Jing Feng. So, we've been able to navigate it with the diverse and broad portfolio that we've had versus discounting, brands that are more super premium.
So, Deborah, a final question to you then. We started off this interview talking about some of those inflationary pressures, and you specifically mentioned the interest rate story and the pressure we're getting there. On a macroeconomic standpoint, we're talking a lot about a cut coming out of the Federal Reserve, cuts coming out of Europe as well in terms of interest rates. From your perspective, as the head of a consumer company, how long does it take for that cut or for that tailwind on an economic basis to show up to the U.S. consumer, or I would say the global consumer? What does that lag look like for you?
Yeah, I mean, look, we have to, certainly these rate cuts, I mentioned earlier, it also certainly impacts the retail and customer environment, and you tend to see that sort of impact first. But, certainly, as inflation, these rates are, the Fed's waiting to cut based on where they see inflation, and actually the inflation coming down should really help the confidence of the U.S. consumer, and, getting those food basket prices, I think would really, boost confidence. So, it's hard to call these things exactly, but certainly, if inflation can abate and you get these cuts, it will help the consumer environment, no doubt.
All right, Deborah Crew, the CEO of Diageo, walking us through her earnings pictures and, of course, macroeconomic environment as well. We thank you so much for taking the time this morning. In the meantime, let's get a quick check on the sensational six, the core six, whatever you'd like to call it, basically the mega caps that are catching a bid this morning. This is interesting in the context of that rotation trade that seems to have faltered just a little bit in the States overnight. A similar story here this morning as well. ASML, I think, is your big outperformer, higher by 2.4%. Novo Nordisk, again, in on that. Even LVMH, which has been under quite a bit of pressure, and Ferrari, both higher as well. Your underperformer, though, this morning is Schneider Electric, down 0.2%. So how much of this is a story of size as a story of defensive? So that's some of your mega caps. Let's talk about some of the individual stocks on the move. Joe Easton doesn't have a drink in his hand, but I think he's starting off with the drinks. Joe.
Yeah, usually I can be fined with a drink in my hand, but you've just come back from a week on holiday, so maybe not at the moment. But look, Diageo, want to check back in. We're down almost 8% now. This is the second rough day for drink stocks this week. You mentioned earlier yesterday we had Heineken slumping following that warning from the beer maker. Today it is Diageo. This is trading at the lowest level in 4 years. The CEO was just speaking about some of those issues, but it does seem to be this 20% decline in Latin American volumes in the last half year that's weighing on the company. Also, North America looking weak in general, and as such, we're seeing a decline in Pernod, Remy and Campari. A number of the peers moving lower, taking a hit from this update that's really shocking the market today. We'll check in with a couple of other UK earnings as well, though. There's a few big ones out. BP gaining around 2% at the moment following that confirmation of $3.5 billion worth of buybacks to come. Sage Group in software getting hit, a decline in bookings for the enterprise software company here in the UK. That one looking pretty rough, down 7% at the moment. And Stamchart pretty much reflecting what we saw in Asia, a 5% share gain following news of $1.5 billion being returned to investors today. There is one stock that we haven't touched on yet, and it is here in the UK. This is Ocado announcing last night a £250 million convertible bond issuance to try and shore up their balance sheet. That will be diluting some shareholders, though, according to investors today. So we're seeing that stock dropping 5%, one of the worst stocks in Europe this morning. In terms of some other earnings to bring you, there was a few in the chemical space that we'll check in on. I think we had one out from Switzerland. There it is at the top there, Sika gaining 2.4%, around 60 billion market cap. It's a big firm, reporting some strong numbers there. A couple of decent decliners, though, standing out. These are falling lower as I speak. Fresenius Medical in the medical tech, the dialysis firm, weak earnings out of them today. And Rexel, this is a building supplier over in France. Both of those slammed following their results. And another one over in chemicals, the nutrition company DSM, another big company, gaining 3%, all earnings linked for those ones. You mentioned ASML. Now, this one does actually have a broker move today. I think that's what's driving the stock. Barclays goes overweight, saying that the concerns around China potentially are overdone. We saw big drops in ASML recently to that stock, gaining 1.9%. And finally, another one getting a positive rating is Eni over in Italy. HSBC likes that one, saying that their gas business is performing better than expected. And I've just been told by the producer we are seeing St James's Place shares soaring, so we're going to bring that one. That is an earnings update as well. I need to refresh myself on that one. That is the wealth manager in the UK, up 16% today. I'll dig into that one, but that one up 16% in London this morning.
Joe Easton from our equity team, thank you very much indeed. Brilliant wrap-up, Joe, as always. Fabulous. Just on St James's Place then, lines crossing. As you say, wow, the stock rallying. It's been pretty volatile and choppy over the last 12 months or so, St James's Place. But this is on the fact that they've seen inflows, first half net inflows that beat, and you are seeing investors reward, of course, the wealth manager on the back of that. So shares in St James's Place, it is the biggest mover across this broader index so far this Tuesday. They're looking at targeted cost savings as well, but the big line on St James's Place is those really crucial net inflows, well above the estimates in the first half, and giving that stock a significant lift. Chris.
Yeah, a whopping 15% is massive. And speaking of share rises, I feel like this is an easy transition to talk about the oil space, because BP, of course, also rising quite a bit this morning, and that's where we're going to dive in next. Shares rallying after the oil giant keeping its buyback steady. That's where the concern was, and hiking its dividend. There's a lot going on in the oil space. There's a lot going on in the earnings space as well. We're going to dive into it with an all-star panel. You don't want to miss this conversation. Stick with us. This is Bloomberg.
Giving season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. We are 20 minutes and 20 seconds into today's session. The picture that you're seeing across these equity markets is that FTSE 100 is the outlier, downside of 0.4%. Some of that can be blamed, a lot of that can be blamed on what we're seeing in the commodities market, with basic resources lagging in terms of the impact on the FTSE 100. Gains coming through for the CAC growing up 0.3%, and over in Germany, the DAX posting modest gains of 34 points across the benchmark. Stock 600 gains of 0.2%, and the earnings story is front and centre as well. BP shares gaining this morning. That's after the oil giant maintained the pace of its share buybacks and increased its dividend as it posts stronger its second quarter earnings from pumping crude. For more, we are joined by Bloomberg's lead on European oil, James Heron, and Bloomberg's senior executive editor, energy and commodities, Will Kennedy. We're going to broaden the conversation out as well beyond BP to look more broadly at this space, because there's some really interesting stuff below the hood. But James, we'll bring you in first on BP and the numbers that came through, because they had warned that the gas trading, oil trading part of the business, refinery margins were getting a little squeezed. There's a challenge there. This was prior to the earnings today, but they've actually come out with a pretty comfortable set of numbers, it seems. What kind of stands out to you?
Yeah, absolutely. I mean, clearly, they made most of their money from pumping oil out of the ground, the most basic part of their business. Other divisions like refining was pretty weak. Gas was a bit weak too. But yeah, the core of their business was strong. They had lowered expectations a bit in advance of the earnings, so we've got to bear that in mind. But yeah, they came in slightly ahead of consensus. And they announced the go-ahead for this big new oil project in the U.S. Gulf of Mexico, which is an area the company talks about a lot and is very excited about for its future growth. And yeah, as you said, the shares have reacted positively, so people seem quite pleased with the performance overall.
You know, it was interesting that we saw this kind of massive, or at least holding on to their buybacks, because at the same moment, and Will, I want to bring you into the conversation here, we also got numbers coming out of Vitol as well, a $6.5 billion payout. Is there a read-through here in terms of kind of the trading businesses?
Trading is a big part of BP's business, and it has done well for them over the last couple of years. I think in the most recent quarter, it didn't perform particularly exceptionally. Vitol has made an enormous amount of money in the last couple of years, and the numbers that we revealed yesterday are slightly historical, but just speak to the rewards that those Vitol traders have gained. Did BP traders make as much money? Probably, but we won't know because they like to keep those numbers under wraps.
Okay, James, look, we're going to get Will's take in terms of where oil goes from here, below $80 a barrel right now on Brent. But what the picture, how that sets up BP then in terms of the quarters ahead. China is clearly a challenge in terms of broadly the price. What are you looking for when BP positions for the quarters ahead on trading and on simply the sale of oil? How challenging is the environment for BP? I guess the numbers today, a bit of a one-off relief for BP. Does it become more challenging in the quarters ahead?
I think so, yeah. Going back to trading, the big boon for BP and other companies in the last few years has been LNG, because you could divert liquefied natural gas from Asia to Europe make a huge amount of money. Now, gas prices in Europe have normalized a bit, so that big cash cow is
Inventories are what, 90% or something?
Yeah,
when it comes to gas?
the European crisis was caused by the invasion of Ukraine really has abated a lot. So they can't lean so heavily on that. But yeah, oil production prices are quite high thanks to OPEC cuts. Now, obviously, OPEC currently is planning to start returning its production to the market from October. So the question is, well, one, will they go ahead with that? They've made sort of conflicting noises about that. And secondly, given the questionable demand picture in China, we'll probably see crude prices start to fall, and that's what could cause problems for these companies.
So you mentioned that the focus, of course, on OPEC, but there's also another focus on the Middle East, and will kind of give us a little bit of guidance here on how do you interpret the developments coming out of course, Israel, Hezbollah, the potential escalation there, but not only there, also in Venezuela. I mean, there's so much geopolitical conflict, and yet the oil price kind of feels a little bit stable in the face of it. Square the two for us.
Let's take those one at a time.
Yeah.
Since the events in Gaza last autumn, there has been some concern among oil traders that it could spiral into a wider regional conflict that involved Iran. But I think traders have got fairly comfortable with the situation. There has been no direct impact on oil production. And I think, in a sense, they expect that to continue. Now, there are risks. Clearly, if we get a major war in Lebanon and then Iran feels that it has to get more involved, there are risks, but I think the market has broadly got comfortable with the situation, the very worrying situation in the Middle East, but the market's got comfortable. Could change, but right now they seem okay with it. If we take Venezuela, there's clearly a lot of turbulence, but Venezuela does not have a huge amount of impact on global markets right now. Its production is only about 1 million barrels a day, but maybe a little bit more. It's not a huge exporter, so the market can take that in its stride. I think the salient point about the market, which James alluded to a moment ago, is that people are slightly concerned about the demand outlook, and particularly the demand outlook in China, which seems pretty soft.
So Brent down 13% since the highs in April. China is a factor. What does OPEC Plus do? James put a question mark over this for us. Do OPEC Plus, do they change their plan on this?
Our current reporting is that they will not do anything this week, although one shouldn't rule out a surprise, and they could come back at any point. I think they won't. It looks like they won't rush to change course. I think they still believe that the fundamentals of the market look fairly tight, and they have a political agreement from the last meeting which they will perhaps not want to upset, because even a decision to delay the increase in production might be unpopular with some members.
Surely something we're going to be keeping a very close eye on. We've got the earnings story. We've got the fundamental oil story. We are prepped with an all-star cast. Bloomberg's leader on European oil, James Harren, and Bloomberg's senior executive editor on energy and commodities, Will Kennedy, joining us around the table this morning. We thank you so much. Coming up, our next guest advises diversifying with gold and infrastructure investment. Speaking of that commodity story and where it shows up in your portfolio, we're going to speak to Nancy Curtin, CIO at Alti Tiedemann Global next. Stick with us. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes then into today's session. A slightly brighter pitch. European stocks up 0.3%. US futures also higher by between 0.1%. Well, about 0.1% for both the S&P E-minis and the Nasdaq futures as well. So some individual stories right now because we have seen some sizable moves. We'll bring you then St. James's Place. That stock currently, as you can see, up almost 20%. This is an inflow story. They have now record AUM of just shy of £182 billion. But net inflows in the first half coming in well above the estimates, just shy of £2 billion in terms of net inflows into this wealth manager, £1.9 billion, and also reiterating some detail around cost cutting at the business and investors rewarding the stock on the back of that detail then.
Rewarding. The stock is flying higher by 20%.
Yeah.
And a similar story, by the way, in Standard Chartered, not to the same extent, I have to admit, but the share buyback is, I believe, the largest on record. A 5% rally there. The profits, of course, beating estimates. They're really pinning that to the strength you are seeing in the Asian kind of wealth story as well. It is not all smooth sailing for every stock out there. Diageo, on the other hand, which ironically is also catering to a fairly wealthy client, I would say, with some of its products, taking a beating this morning, down about 8% here. A lot of this has to do with weakness in consumer sales in the States, but also in Latin America, where it looks like that was their big growth area. And they're saying, look, the inventory just hasn't gone through. Interest rates are weighing on the consumer, and there just isn't that consumer appetite outside of, I believe, celebration is what Deborah Crew, the CEO, just told us. Nevertheless, not enough to stem the losses this morning, down about 8%. So those are some of your individual stock stories. Let's get a little bit more market analysis here. Joining us now, Nancy Curtin, CIO at Alti Tiedemann Global, joins us around the table. Nancy, a pleasure to have you on the program.
Likewise, good to be back.
I won't ask you what your favorite Diageo product is, but I am curious about your thoughts on the consumer, because look, we're hearing this kind of weakness story out of the States in Diageo. We heard it in McDonald's yesterday. You're seeing cracks in the data. Is this the beginning of the end of that American resilience?
We don't think so. So first of all, the first estimate of Q2 came in at 2.3% for the consumer. And I was encouraged because it wasn't just spending on services, which had been up 3% in the first quarter, but also spending on goods as well. Now, remember, there's a real bifurcated consumer in the United States. You have mid to upper consumers doing just fine. They account for 88% of consumer spending. It's the 12% that I think you're referring to. I don't know about Diageo, what's going on there, but largely the the low-end consumer, we are seeing credit card delinquencies rising.
Yeah.
We are seeing some strain in that area. They don't have stocks. They don't have maybe a home equity where they're seeing their house prices rise. They don't have cash and deposits making money. So that's where the strain is, and that's why we think the Fed will probably cut rates up. Not tomorrow, but as we head into September.
But even into September, I mean, you still have a PCE deflator that came in hot. That's the Fed's preferred gauge, of course, for our international audience. How do they square that? What data point does the Fed respond to here when the data is all over the place?
So I think they're going to talk about a balance tomorrow, which is they have to think about their dual mandate, which is, price stability on the one hand, and I think inflation is really getting back towards their target. Now, we see some structural reasons inflation could move higher as we head into 2025, but near term feels like on the price stability, they're getting pretty close to their target. They've got 2 more inflation numbers before September, but also the cooling of the labor market. Remember, the Somme rule, if you buy into that, would indicate that they need to cut. Well, let's talk about the Somme rule. No, let's not. No, but I'm saying, the balance, I think they'll talk about tomorrow, that the balance of risks on both sides would probably, if the data continues, encourage them to cut in September. That's our thought.
I think the architect of the Somme rule has also been talking about the Somme rule. But,
probably.
So talk to us about what this means. So your expectation that ultimately this is still this lining up for a cut from the Fed.
Yeah.
What does that mean then for Russell 2000? What does that mean for the small caps, for the cyclical trade? How much is priced in at this point?
Okay, so if you look back in history, going back to like the 90s, when the Fed first cut comes, small and mid cap outperform large cap. So we think this rotation continues that we're beginning to see. And we think it continues not only because that's what happens when the Fed cuts rates, they tend, and the more cyclical parts of the economy get relief, but also investor expectations are for earnings acceleration in the other parts of the market in mid-cap to improve as the year advances and into 2025. So we think for those 2 reasons, the rotation continues. The rotation is hugely important, by the way, for the ongoing health of the stock market. We can't have a bull market just based on, well, let's call it 6 stocks. So we need this greater breadth and depth. And that's been our view that would happen. By the way, we like mid-cap over small cap. Better profitability, more leverage to the onshoring of production, more industrial. So we kind of like that. Small cap still well.
Yeah, that's interesting. What takes you from mid-cap to small cap then? And how are you thinking about the political overlay? Because there's an expectation if you get tariffs from a Trump presidency, still an if, of course, that benefits some of those domestic firms. So what are the catalysts that move you from mid-cap to small cap, and how are you thinking about tariffs?
Well, both small and mid cap have more domestication, than large cap. So that's number one. We get it both for both of them. Small cap, you have the regional banks, you've got some highly unprofitable companies, and you also have a lot more leverage. So that can rally, but we like mid cap. There's a greater profitability screen, greater cash flow in the mid cap sector. So, that's our view. And by the way, when the Fed cuts, they rally about the same. Small cap leads a little bit more, but on a risk-adjusted basis, we think mid-cap is the place to be. By the way, and the other 494 shares, let me not forget those as well, we think they'll continue to do better as the year advances.
It's an interesting dynamic because, and I'm going to kind of harp on and piggyback on what Tom just talked about. How much of the rotation is that Fed story? How much of it is the Trump trade? And the reason I ask this is in the context of fiscal spend. We're seeing it in Europe. We're seeing where fiscal is outweighing the help of the monetary, where what Giorgia Meloni's government is infusing into the economy is outweighing what the ECB is able to help with the Italian economy. Do we see the same thing in the States, especially in a Trump 2.0? Do we see the benefits of the Inflation Reduction Act, for example, in terms of fiscal spend, disappear? How do you square that?
I mean, I look at the Inflation Reduction Act and I look at the CHIPS Act and I think, oh gosh, it helped both red states and blue states. I mean, he's really going to repeal that. I don't think so. And also remember, it's not just about who wins the presidency, who wins Congress as well. And at the moment, the markets are looking at a historic flip. Democrats taking the House, Republicans taking the Senate. So look, fiscal spending under either candidate likely to continue. And one of our medium-term concerns is around debt sustainability in the United States. We do worry about that. But by the way, maybe one of the reasons the Fed cuts, a recession would not be good for the deficit. What happens when you go into recession? deficits typically double. Right? So automatic stabilizers kick in, you get less tax take. That would not be a good look.
Nancy, I'm so glad you mentioned the deficit.
Yay.
This is my favorite topic. What happens, I think it was like the second week of January, you don't have whoever the new president is sworn in yet, and you hit that debt ceiling. The government goes into shutdown, they're negotiating, whatever. What happens to the markets? Like, what does those 24, 48 hours look like if it takes as little as that to come to a deal? Is that a bid into the bond market? Is that a bid into the dollar? Is 2011 the roadmap there?
Well, debt ceiling in 2025 is really in the future. But our view is that the yield curve steepens, so the short end comes down. Not aggressively. We don't expect aggressive cuts on the part of the Fed, but we think there will be pressure on the long end, not just because of the debt ceiling, just because of the tsunami of debt issuance, because investors need to be compensated for the size of the deficit. By the way, the debt gets worse no matter who gets in. We've got an aging demographic, Social Security, healthcare. We got interest cost as a percentage of GDP is going to rise. We got populist policies. Let's help that low-income consumer. You add all that together, and we think the markets will be focused on debt sustainability heading forward.
So you're pretty positive on gold then. We're looking at about just shy of 2,400 on the precious metal. Talk to us about, is that the hedge? Is that the hedge to the deficit? Is that hedge to the Fed? What is that doing?
So we have a basket of what we call diversifying assets, which consist of gold, because that's nice and liquid. It's done very well. Thank you very much. It does well in a higher, sort of debt environment, not to mention geopolitical risk. So like gold out there. But we also have things like infrastructure, private credit, where we have about a 2% yield versus what you can get in the public markets. We think we're actually buying into companies and structures that have a lot more safety than high yield. We're looking at equity-like returns with fixed income risk. So we like that too. We also think volatility picks up. That's good for hedge funds. So we've got a diversified portfolio: gold, infrastructure, private credit, hedge funds. Again, it's all client dependent, in terms of what the risk return are, but we're using a range of asset classes to provide that diversification.
Just going back to your mid-cap call, how are you funding that, and what do you do with tech? Is tech the funding mechanism for that mid-cap play? We've got the earnings stories coming through from Meta, Microsoft, Amazon, Apple this week. How are you thinking about mega-cap tech?
Big week ahead, right? We are an open architecture firm, so we invest with external managers. What I can tell you is our global managers are reducing their tech exposure, not to zero. They're bringing down exposures, and tech has run well. It's done well, right? Except the last week, to the tune and the favor of the other parts of the markets where they see accelerating earnings that I talked about at more attractive valuations. And we think that's positive. It also kind of de-risks the portfolio. So we think, look, the other part of the market trades at 15.5 times earnings. That's about 20% below the 10-year average. Tech, Super 6, trade at 30 times earnings. That leaves them vulnerable to disappointment, although I have a feeling earnings will be okay. We'll see. Who knows? Later this afternoon, who knows?
Well, it's interesting because it kind of contrasts what we heard from Wei Li of BlackRock yesterday, who was saying, look, the rotation trade may run a little further, but it's going to hit a wall when NVIDIA reports later in August, and BlackRock are very much still all in around mega cap tech and the AI theme, saying don't stress out too much about that whole return on investment theme and story and angst. When it comes to the story back in terms of debt load, because this is front and center for so many people in the US and this fiscal expansion that you're likely to get from either president. When did the bond vigilantes start to take notice? Because so far the auctions stateside from the Treasury have been pretty well absorbed, and so there's been a lot of hand wringing. But when the rubber hits the road, buyers are they're out there to absorb that debt.
I think 2025. So we talked a little bit about that.
To be clear, the bond vigilantes come back in 2025. That's an issue for the US in 2025.
I think so. I think so. I'm waiting for them. They're hidden at the moment. But no. Look, as the debt and deficit continue to rise, at some point people are going to wake up at the tsunami of issuance. It's one of the reasons we've been underweight government bonds in our client portfolios, but actually
at the long end, but not at the front end.
No, the front end, no, we're at the long end.
Give us a ceiling. Yeah. Give us a ceiling on yields here.
I mean, look, we're 4.1 at the moment. We could easily go back to 4.5. Our long-term view is I think we could go to 5 with the size of the debt and deficit. Yeah. By the way, one thing that can help here, to the extent that the governments use fiscal spending in investment in infrastructure, That expands the productive potential of an economy, and that means you can grow faster, right? What does Chair Powell say? Debt's growing faster than GDP. Solution? Debt goes down or GDP has to go up. So got to think about those things as well.
Nancy, always a pleasure. Thank you so much for
Likewise.
coming around.
Thanks so much for having me.
CIO at Alti Tiedemann Global. We thank you so much. Man, she covered a little bit of everything. I think we're done for the day now. Coming up on the program, not quite yet though. We've got the Italian Prime Minister Giorgia Meloni offering to broker better trade relations between China and the EU as she meets President Xi Jinping in Beijing. We're going to dive into the details, what it means for the rest of Europe. Stick with us. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back to the opening trade. We are 46 minutes into today's session. Pretty decent gains actually coming through across the European benchmark, up 0.4%. Individual stories like Standard Chartered and BP, St James's Place here in the UK helping to lift these markets. Diageo, though, on the downside. US futures, meanwhile, pointed to gains of 0.2%. Let's get to the geopolitics right now, though, because Italian Prime Minister Giorgia Meloni has trumpeted China's potential for helping bring an end to Russia's war in Ukraine, calling it, quote, a key player in the process. Meloni is in China for her first official visit since coming to power. Joining us for more is Bloomberg's China government and economy reporter Lucielle Liu, joining us out of Beijing. Lucy, what were your key takeaways then from Meloni's China visit? It's been quite the about turn for Italy. They got on board with the BRI, then they moved out of the BRI. She's been meeting with Xi Jinping. What's kind of stood out to you?
Yeah, that's right. The sort of charm offensive after sort of pulling out the BRI. So yeah, absolutely. That key player in ending the war in Ukraine, I think, lending more legitimacy to China's, efforts to cast itself as exactly that, this peacemaker on the world stage. We know that its, special envoy for Eurasia affairs, Li Hui, is going on yet another round of shuttle diplomacy, this time to Brazil, Indonesia, South Africa, to, as the foreign ministry puts it, build up conditions to resume peace talks. And of course, they've recently hosted the Ukrainian foreign minister here in China. Interestingly, not in Beijing, they avoided that, but they met in Guangzhou. And, I think right now we can really see China trying to position itself, especially as the U.S. elections come into view. And, with Trump making these comments like he can end the war in 24 hours, China also angling to see what role it can play in ending the war in the Ukraine.
So, Lucy, I'm just looking at some of the trade data on the Bloomberg terminal. China is Italy's 4th largest trading partner. You can't even find Italy in terms of China's top 15 trading partners. What is China getting out of this?
Yeah, I mean, of course, we know with the EU, the major friction point now is are those EV tariffs, and so of course, trying to gather as many friends as they can in the region. Of course, trying to engage with them individually rather than face the bloc. It obviously has an advantage in I guess engaging with them bilaterally. And so while it's quite unclear what kind of role Meloni has, how much clout she has in being able to be that broker or mediator that she says she can be, we know that she was sidelined following the European parliamentary elections in June. So while that's unclear, I think China is happy to have as many friends as possible right now in Europe.
All right, Bloomberg's Lucille Liu, we thank you so much for giving us that crucial context. It's a strange friendship, but perhaps the beginning of a long one. We thank you so much. And I want to stick with what's going on over in Asia and pivot to Japan, where many small businesses are struggling to figure out how to raise prices after decades of deflation. Now, the pressure has prompted some company owners to take classes on negotiating higher prices in order to survive. It is the topic of our Bloomberg Big Take. Joining us for more on it is our senior editor, Reed Stevenson. Reed, I think you sat in on one of these classes. What was that like?
Indeed, it's kind of a surreal experience, but essentially I went to this city called Matsue in western Honshu, the main island of Japan, because I learned about, just regular small businesses taking classes on how to transfer costs to their customer. Now, what you have to understand is, like, for the better part of 30 years in a stagnating economy and deflationary environment, many people at a negotiating table in Japan have never had to ask their customers to pay more. It's sort of like the lost art of negotiation. And so what I discovered were that they were going, listening to an expert on negotiations on how to go to their customers and make a case for them to pay more, which really is a critical part of the economic engine that the Bank of Japan is trying to get going here in Japan.
It's interesting. In terms of which companies are affected, I mean, is this across the board that the Japanese companies just cannot and haven't been able to raise prices over a long period of time? How ingrained is this within corporate culture that it has to be unpicked? Is it small companies, large companies, or across the board?
Yeah, it's the smaller companies. So, the Toyotas and the Sonys of Japan, they're fine. They have exports. They're used to inflationary environments. They have pricing power, brand recognition. But the smaller and mid-sized companies, which actually make up 90% of, the businesses in Japan, they're the ones that are very often at the mercy of these larger companies. They haven't been able to go to them and push for higher prices. And of course, you do in fact have some inflation in Japan. A lot of it's imported. For example, higher energy prices. With the yen so weak, there's a sort of imported inflation as well. And so their workers are also asking for more money. And so they're kind of getting squeezed in the middle there. Now, the central bank, which is starting its two-day policy meeting from today, has often said that it wants to see, sort of robust inflation in order to go beyond this sort of ultra-loose monetary policy that they've had. And so what essentially needs needs to happen is that in this sort of middle sector where the companies are getting squeezed, you want to see a healthy wage price cycle at least start to get going so that you can have a more normalization of the Japanese economy.
Okay, Reid, thank you very much indeed. Really fascinating. It is the big take of the day, of course, really important on a week, of course, where the Bank of Japan makes that crucial decision. Do they turn a little more hawkish, raise interest rates and cut their bond buying? Expectations are that it's a bit of a knife edge in terms of the interest rate story. Expectations around the bond buying cuts are pretty well baked in. So we'll see. Of course, the Japanese yen, softer in the session today, but in terms of the gains that come through, still nearest the strongest level in about 12 weeks for the Japanese currency.
Yeah, it's an interesting one because it kind of eats into the broader macro play in that if you aren't watching the BOJ or if Japan isn't part of your portfolio, well, the carry trade absolutely is. And that's where you're starting to see a lot of the pain, especially if we're talking about rate cuts coming out of the United States. That has a ripple effect at the EM space. And then you're getting also doubly hit by that Japanese strength as well. So that kind of narrows the spread that you would catch. That's my very nerdy way of saying that the BOJ actually matters more to an international audience than I think it has in the last couple of months, simply because it was going in the opposite. It was going against the grain of a lot of these central banks. I'm curious how much of that affects the thinking of the Federal Reserve, of the BOE, et cetera. Does what happens in Japan suddenly matter to some of these other central banks?
Well, it's the carry trade, but it's also the fund flows story. So as rates edge higher in Japan, investors in that domestic market start to repatriate funds from their overseas holdings. That could put pressure on the bond markets and on sovereign debt of other countries in Europe, potentially the US as well. So it is a fascinating dynamic and really interesting, of course, that Governor Ueda has not spoken. I think he's been in his quietest period leading up to a BOJ meeting for many a year. So he's been very tight-lipped. So that volatility, that uncertainty is there ahead of that decision tomorrow.
Yeah, and I think there's a little bit of a parallel here because I'm having a little bit of deja vu because when you talk about those capital flows in particular, this is something that the U.S. has to deal with as well when the dollar plays that haven role. Emphasis on when, because it hasn't been lately, especially given all the political turmoil you're seeing out of the States. You also talked about the wages story. That's a conversation that's happening in the States as well, in the manufacturing sectors. How much of that push, especially in the geopolitical climate and up ahead of the election, is that driving some of the electoral politics? We know that Kamala Harris, for example, has been speaking and trying to get some more of the endorsements of some of the unions in the States as well. So that's going to be something we're watching on the political stage. The data still matters, though, and I think I'm channeling Jay Powell when I say that, which is why the data coming up in the next 24 hours is really crucial, especially when it comes to Europe. Because at about 10 a.m. UK time, you've got the Euro area GDP. And I should mention in the next hour, you're getting numbers, some preliminary numbers in the regional spots of Germany. But that big German headline CPI number coming in at about 1 p.m. UK time. But then at 3 p.m., you have UK, US data, JOLTS, Conference Board, consumer confidence. There's plenty going on, plenty of data points. The question is, does it tell a similar story, or is it all over the place? That's the thing we were just talking about with Nancy Curtin. And the Tom, your favorite, L'Oreal earnings, I'm sure, but I was going to say the tech earnings is really your arena. But I think for Europe, L'Oreal and Airbus is the
L'Oreal,
focus.
interesting on the consumer. St. James's Place getting a real lift. The stock just absolutely charging higher in the session today on the inflow story for St. James's Place. It's had a bit of a challenged year, this company, this wealth manager, listed here in the UK. But today, what a session for St. James's Place. One of the leading stocks in the session so far on inflows. Higher in the first half than had been estimates, gains of close to 20%. And then, of course, we have Microsoft later today with a focus on cloud and Azure.
Yeah, there's a lot going on there. And then to your point, St. James is rallying, Standard Charter's rallying higher by 6%. You also have, of course, Diageo taking a pretty big beating. So we are basically deep in the European earnings season. There is plenty more to come. Airbus, for example, posting their numbers later. We're going to be speaking with the CEO, Guillaume Faury, at 8:10 p.m. UK time. Our U.S. colleagues are going to carry that interview. But it's a really interesting one, given the pain that you were seeing in Boeing. Now, of course, Guy Johnson talked to him over at the Farnborough Air Show. We'll see what these numbers look like, what these backlogs look like, lifting the hood off of a really interesting industry right now, especially as we talk about perhaps some of that waning consumer demand around the world. That does it for the opening trade. You've got me up for the Pulse up next. Stick with us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BP shares rising after a profit beat as it keeps buyback steady and hikes its dividend. Meanwhile, oil trading giant Vitol posting a record $6.5 billion payout. It's not all good news, though. Diageo sinking as a slowdown in Latin America, the Caribbean, and the U.S. pushed the distiller to its first annual sales decline since the pandemic. Plus, on the broader economic front, French and Spanish growth beat forecasts and a boost for the euro area. We're going to dive into the German and Italian numbers next, plus what it tells us about the ECB. I want to get a quick check on these European markets because, of course, you are seeing a little bit of green on the screen when you look at the broader continent, but underperformance in the UK. Now, a lot of that has to do with the oil story that you are seeing in the UK. It also has to do a little bit with the Diageo numbers. We're going to dive into some of the details that you're seeing, but the cross-asset story is important as well, especially given the amount, the data deluge that we are getting. Euro dollar is at 108.17, still hanging around that 108 handle, 128 on cable. And we're also seeing a slight weakness in the yen, coming off of a pretty strong bout of strength. And Brent crude trading just shy of an 80 handle. A lot to digest. Let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. I want to start off with the earnings story because that's what seems to be what's moving the markets the most, because you are seeing some green on the screen when it comes to those financial services. You are also seeing green on the screen when it comes to the likes of BP, but Diageo is the one that's taking a beating. And this is interesting simply because it's down about 10%. It's talking about a weaker U.S. consumer, a weaker product demand story in Latin America as well, which is one of their main growth areas. And the idea of headroom to actually hike up some of those prices to boost some of those volumes is not quite there yet. And again, that is significant for the broader macro story. We're going to revisit some of those numbers later. BP also higher this morning, despite actually some concerns around some of their refining margins. They're sticking with their buybacks. They're keeping them steady. And that is a big win in this market, higher by about 3%. That is going to be crucial. Some green on the screen for Standard Chartered as well. Again, a record buyback plan coming out of Standard Chartered. They're actually saying we're seeing more wealth consumers in Asia, and that is feeding into into our bottom line. That is all positive for the buyback story. And of course, St. James, again, net inflows, again, wealth at the very top of that income brass, really feeding into some of these financial managers. A whopping almost 20% gain for the company. St. James there, of course, we're going to be diving into that story later as well. Let's go a little bit broader here and talk about some of the GDP numbers that are breaking, specifically when it comes to Germany. Now, we are waiting for the headline CPI number that's going to come in about 1 p.m. UK time. But for now, when you do actually look at those German numbers, the GDP forecast is coming in, falling by about 0.1% quarter over quarter, bang in line with estimates. So you're not seeing that much reaction in terms of the European story. We are, however, getting some of the regional data, and I think that's where perhaps we pay a little bit more attention. I want to go into the CPI numbers coming out of Saxony, that crucial area as well. On a month-over-month basis, you're looking at a rise of 0.6%. The prior was 0.1%. So this is interesting coming out of Saxony. When you look at North Rhine-Westphalia, which is the other one, Westphalia, I should say, which is the other one we keep our eye on, the year-over-year number is 2.3%. The prior was 2.2%. So I would say hot numbers in those parts of the regional story. How much of that shows up in the data that we are going to see in the 1 p.m. session or in the 1 p.m. kind of data deluge as well? That's the Germany story, especially in the context of that weakness. Let's talk about Italy as well, because you did get those preliminary second quarter numbers. The GDP there rising, again, bang in line with estimates. That is on a quarterly basis. The year-over-year basis is about 0.9%. The estimate was 1%. I think the takeaway here, broadly speaking, is that the outperformance in GDP numbers is coming from France and is coming from Spain in the last quarter, but the CPI numbers are coming in hot as well everywhere. So this idea that perhaps that disinflationary trend is accelerating, I'm going to throw a little bit of cold water on that in terms of the data that we get this morning. But don't take my word for it. Let's bring in a true expert. Freya Beamish, chief economist at TS Lombard, joins us this morning. Freya, I am losing my breath to keep up with all of this data, but I'm curious where you think the strength is coming from in Europe.
Yeah, I don't see it as lasting very long. I'm on that side of it. I think we have had a little bit over the beginning of the year, turning in the trade cycle, some improvement in industrial production. When I look sort of to the next kind of 12 months or so, what I'm worried about is that this data today will prove to have been a bit of an illusion, that policy is too tight, and that we'll be seeing the repercussions of that with the kind of the lag speeding through over the next kind of 12 months or so.
So when we talk then about where the cues are coming from in terms of the European economy, are we still very much paying attention to that manufacturing weakness in Germany? And I'm putting that in the context of that weak IFO data that we got last week as well. I'm curious if that is still the sticking point, or do we need to be worried about cracks showing up in Italy, in France, or is this still very much a Germany story?
It's very focused on Germany because Germany is the one where kind of there's been a big global shift here with sort of the relationship with China. The sector is very exposed to tight. The economy has sectors that are very exposed to tight policy. So a lot of that kind of industrial story of industrial weakness, construction weakness, is partly related to China, but also a lot of those same sectors are very related to, are very sensitive to over tightening of monetary policy. So at this stage in the game, it's hard to sort of work out exactly which one of those is the driving force. But certainly policymakers have control over their own policy, and they don't have control over the relationship with China. So I think we'll see policymakers starting to move more rapidly as we go through into the next kind of 12 months or so, really catching up with where they should have been earlier in this year.
So Freya, in the last week or so, you've started to see the market, and a lot of this is coming off the data that we got in the States, start to price in cuts in September and actually double down when it comes to what the Federal Reserve is going to be doing next. Is the ECB and the Federal Reserve officially on the same page? Is that narrative of policy divergence in the rearview mirror?
Yeah, I think the ECB was always going to have to cut first, was always going to have to move first, because the strength, the demand strength was always in the US. There was a positive aggregate demand shock in the US, and there wasn't elsewhere in the world. There was just a preservation of demand. So it was always going to be that the US was going to take longer for things to feed through, and that sort of breaks with the traditional relationship between the Fed and European central banks. I think we're now getting to the stage in the US where, as Powell is saying, that the two parts of the mandate are coming closer into balance. So we'll see the Fed starting to get onto the same page with cuts there, and that should come through in September.
Well, it feels like they're responding to some of the cracks that we're seeing in the data. And by the way, we're seeing it in the corporate space as well. We just had a conversation in the last hour with the CEO of Diageo. We had some poor numbers coming out of McDonald's as well when it comes to the consumer story. Walk us through the delay here. Let's say they do cut in September. How does that show up to the end consumer? And does that help maybe stem some of the pain, some of the weakness you're seeing in the States?
Yeah, I think the pain actually for me in the States is probably a short-lived thing. So around in the first half, sort of around Q1, we were starting to see deterioration in the leading indicators with regards to the labor market. That tells us that there's probably a soft patch coming through in the middle part of the year. But since then, we've actually seen some of those leading indicators start to bottom out, which tells me it's more of a soft patch than a sort of a serious deterioration. I think in order to get ahead of the curve, the Fed probably does need to start cutting now. On the QT side of things, I'm not quite as concerned. I think there's still a lot of liquidity out there. It doesn't seem as though we're running into any plumbing issues at this stage in the game. But certainly in the lower income parts of the distribution, that's where we're starting to see people running out of money, and maybe that's where some of the softness is coming through. Similarly, small firms that are not represented by sort of market moves and kind of are not really picked up in credit spreads, much more reliant on banking. Those types of firms are probably running into difficulties at the moment. So a rate cut is appropriate to sort of bring those guys, or to sort of soften things a little bit for those parts of the economy. But overall, we still see reasonable resilience in the U.S. economy.
So that resilience that shows up in the U.S. economy, that may catch that tailwind in September if we do get a cut, also has global implications as well. Freya, to what extent does the November U.S. presidential election get in the way of what the Federal Reserve may need to execute in the back half of the year?
Yeah, it's a tricky one, and certainly Trump has been talking about trying to ward off that cut, talking a lot about inflation. I'm assuming that he's more worried about them cutting, and that's why he's talking about inflation rather than he's actually genuinely worried about the stickiness of inflation, because most of his policies seem to be pushing in the direction of a more inflationary economy, which is not necessarily a bad thing if it happens within within the confines of strong institutions. What we like about the U.S. economy from a kind of a 2 to 3 year time horizon, thinking about U.S. facing stocks, thinking about real economy facing stocks, is that there does appear to be this repressurization of kind of politicians on both sides of the House listening to what's required of them by the electorate, which doesn't really seem to be coming through to the same degree in Europe. And that kind of repressurization in which you get tight labor markets feeding through to strong capex growth, creating productivity growth, all of these lovely kind of synergies that have been dormant for the past kind of 15 years or more. Those types of things are what we're looking for over the kind of the 2 to 3 year time horizon. I think coming back to your question, in the meantime, I think the Fed will probably do what it perceives is necessary to be done, and suffer any kind of political consequences.
All right, Freya Beamish, we have to leave it there. Of course, keeping apprised of the, not only the Fed's path, but where the U.S. political story goes as well. Chief Economist over at TS Lombard, we thank you so much for putting that into a little bit of perspective. Coming up, it's a tale of two corporate stories this morning. A sobering result for Diageo, the maker of Johnnie Walker and Guinness, reporting its first fall in annual sales since 2020. A lot of the pain coming out in the Latin American sector as well. Weaker consumer story out of the States that we were just talking about with Freya combined with some strength out of BP. We're going to dive into the details next. This is Bloomberg.
Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies. We're calling it a cautious consumer, a U.S. consumer that's quite cautious in spending. Wallets are under pressure as inflation is persisting. You're seeing, 30-year high grocery, food basket prices, and that has certainly impacted us. Additionally, interest rates remain high, and so that's impacting retailers. We've had some retailer destocking this year.
CEO of Diageo, Deborah Crew, they're talking about the inventory story, talking about the potential weakness you are seeing in their numbers as well. That is showing up in the stock market in a really big way. The shares plunging after that slowdown. Latin America, the Caribbean, and the U.S. talking about the potential weakness in the U.S. consumer. Also talking about the LatAm being their bigger growth area. You combine that with the green on the screen we're seeing in the likes of BP, for example, makes a very interesting market trade. Buybacks seem to be the story in the oil space right now. Let's dive into both big stories. Bloomberg Saba Meddings joins us around the table alongside James Harrant, who we'll get to in a moment. There's a lot going on here. Bear with me, but let's start with the drink space. Let's start with the negative, because we are journalists at the end of the day. We got to start with the doomsday. This is fascinating to me because we had Heineken come out yesterday and tell a similar story about that consumer weakness. How much of this is drink specific?
Well, I mean, they're both obviously quite different companies. Heineken very focused on beer, Diageo very focused on spirits. Obviously, it sells Guinness as well. What you've traditionally seen is as consumers have perhaps switched away from beer, companies like Diageo have benefited. What we saw today is this whole move to premiumization that you've seen with Diageo is actually kind of coming back to burn them a little bit, because there is that real cautious consumer. They don't want to spend as much. And if we look at the US, volume's down 4% for Diageo in its biggest market, and a big falls come from tequila, which has obviously been a great growth for them. We saw Casamigos, one of their brands, down 22%. So people are definitely spending less. They're kind of running down what's already in their cabinet at home. And then you're seeing retailers order less because they don't want to get stuck with these big inventories. So it's really interesting. And also, like you say, the forward look, there doesn't seem to be any sign of this kind of picking up. It was quite a stark commentary we have from the company today.
Yeah, and I found it fascinating because, of course, we just heard from Deborah Crew when she was on the program with us. She was talking about, and I've never heard a drink maker really talk about this, but interest rates affecting purchasing ability for a thing like spirits. I've never made that connection before, but she makes a crucial point in that's kind of the part that's eating into their bottom line, and that the pricing pressure is so large that they don't actually have that headroom. That's something we heard from Heineken as well. So what gives first, the volumes or the pricing?
Well, I guess that it's a balancing act, isn't it? They kind of have to decide, do we push up pricing to sort of protect our margin, or do we hunt for volume? I think it's going to be an interesting one to watch in the coming months as they try and work out that balance. But definitely we are seeing volumes fall. And yeah, as we saw that sales fall as well. So it kind of looks like they're losing both at the moment.
Yeah, it's fascinating, especially at a time when I think there's a lot of pressure along companies broadly to just kind of stick to what they've promised. And I think Diageo maybe didn't do that this time around because they were so excited about the Latin American story. And I would say that's maybe where BP, by comparison, actually won, because they made some big promises on the buybacks. There was concern they would go back on those promises, and instead they didn't. James, walk us through this buyback story for BP.
Yeah, as you say, there were some questions. Gives its dividend by as much as was expected. And the story there really is the mining industry has been pretty poor. But BP stuck to its buyback. It increased its dividend by as much as was expected. And the story there really is the strength of the profit is coming from the core of their business, pumping crude out of the ground.
Yeah.
And the reason that they're making so much money in that is largely down to OPEC. OPEC has been restraining production all this time. And even though demand is looking a bit soft, OPEC for the moment is still cutting production. Oil has been above $80 a barrel for most of the past quarter. And so that really was the big driver of profits for BP.
So understandably, and then the buybacks are clearly what's driving the stock this morning, but there is still that concern about refining weakness, that margin weakness as well. Can you talk to us a little bit about the trading weakness that we might be seeing in BP, especially, and I want to ask you about Vitol, but we should point out that Vitol just announced a record buyout, $6.5 billion in terms of a dividend. Where does BP stand in terms of their trading business?
Yeah, and I think trading looks weak now because of where we're coming from. So the Vitol numbers that we saw, the incredible dividends they've given to their employees, were for 2023. And BP and the other oil majors made huge amounts of money in those years too, because price volatility was sky high. They were making a lot of money trading gas around the world. So we've come back to more normal levels for trading profits, but obviously that seems low now in comparison to what we've seen for the last few years. So they've had to fall back on their core business, which is, pumping oil out of the ground.
All right. So, again, a tale of two corporates, a really fascinating one. There's a consumer story in both of them. Bloomberg Saba Meddings and our leader of European Oil, James Herron, joining us both this morning. We thank you so much. Coming up, we're going to dive into a little bit what James was just talking about in terms of the geopolitics and some of what's going on in the Middle East and Venezuela, by the way, driving some of that oil story. We're going to dive into the Venezuelan story, where the opposition says it has proof of election fraud as thousands take to the streets to protest what they say is Maduro's illegitimate win. We're going to dive into the details next. Stick with us. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Now focus on election results over in South America, where Venezuela's opposition party says they can prove that it won Sunday's election as protests broke out in the capital, Caracas, following the disputed vote. I want to get more on the details here, bring in Bloomberg's Alan Crawford, who, of course, has been following the story detail by detail. Alan, can you just give us a lay of the land here? What do we know? What's the latest?
Well, after those scenes of protest that we saw yesterday, then the leader of the opposition, Maria Corina Machado, who of course was barred from standing, she wasn't allowed to stand, she said that the opposition's main candidate, Edmundo Gonzalez, they had proof that he had won by something like 70%. So that was stepping up the confrontation against the president, Nicolas Maduro, who of course claimed victory. He, meanwhile, then issued a statement late at night where he declared, he'd announced the protesters as criminals, said they were being paid $150 to turn out. So essentially the tensions are ratcheting up.
And is this something that the rest of the world has a view on? Walk us through the international reaction.
Well, to some extent, it's been business as usual, in the sense that you saw that predictable allies, Russia and China, lining up behind Maduro. The US said that it had serious concerns about this election result. But I think what's arguably more interesting is that some of Maduro's, what might be regarded as regional allies, leftist governments in Brazil, of Lula in Colombia, next door, of Petro, and also of Mexico, they were coordinating. They were clearly unhappy with this outcome. They have questions, and so they've been coordinating their response, and I think that that's key to watch.
It's certainly something we're going to be watching as we monitor the developments and see whether or not some of that international reaction can actually move the dial when it comes to Venezuela. Bloomberg's Alan Crawford, we will leave it there, but we thank you so much for that crucial context, of course, as we watch the geopolitics there and we watch how that shows up in some of the market reaction. We've got our eye on Venezuelan dollar-denominated bonds. We've got our eye on oil prices as well. Limited exposure when it comes to Venezuelan oil in terms of the international market, but something we're going to be keeping an eye on. And something I'm keeping an eye on in this part of the world is going to be those European movers, and specifically in the stock market, where we are seeing off the back of earnings, Diageo taking a big beating, down about 10% relative to St. James Place, which is seeing massive inflows and a massive stock rally on the back of it. Those shares higher by 21% amid a sprinkling of other positive numbers. We're going to dive into it. Stick with us. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Let's get to your top stories. It is earnings palooza. BP shares rising after a profit beat, keeping its buyback steady and hiking its dividend. On the other hand, oil trading giant Vitol posting a record $6.5 billion payout. It is not all calm seas. Diageo sinking as a slowdown in Latin America, the Caribbean, and the U.S. push the distiller to its first annual sales decline since the pandemic. A weaker consumer story weighing on those shares. Plus, Boons erasing their earlier gains after German GDP data surprising to the upside with a drop in the second quarter, but the inflation number surprised to the upside, In contrast, France and Spain growing far more than predicted. Let's go back to the banking story because that's where a lot of the action is this morning. Standard Chartered making waves as the shares are higher by about 6%. The London-based bank saying it would ramp up its multi-billion-dollar share buyback program. Now, this all comes as it reported a beat on second quarter pre-tax profits driven by its wealth business.
What we've said to shareholders is we've got a strategy. We're pursuing the strategy. It's working quite well. Earnings are strong. We're managing our capital very, very directly and I'd say quite actively. And that's allowed us to return any surplus to shareholders. And we've said, especially given where our stock price is, which is not as high as we think it should be, we will buy back as many shares as we can with surplus capital. That's what we're doing. If we keep on performing, of course, we can keep on buying back shares.
A strategy that's working, says Bill Winters, the CEO of Standard Chartered. Let's get a little bit more analysis here because it's not the only company that came out with pretty strong numbers. Nomura did, so did St. James, and you're seeing some pretty big moves off the back of it. I want to bring in Filippo Alawati, head of financials over at Federated Hermes, for a little bit more analysis. Let's start with the Standard Chartered story because this big boost and the announcement for the buybacks is really coming off strength that they're seeing in Asia. A wealthier client driving their results is similar messaging you heard out of Nomura. Where did this come from, especially in the backdrop of Asian weakness?
Yeah, not exactly. It's an interesting point because we're seeing all those companies coming out also with strong numbers from especially the Asian wealthy. And I guess that's what my reading is that the wealthy people in Asia are actually better than we made up them to be. And I think Bill Winters in this context is very right because it's clearly said that there are opportunities that are very expensive, so it's better just to return the money back to the shareholder as they achieve the return targets.
Well, Standard Chartered isn't the first to talk about this. I think in the last earnings season, we heard likes of Unicredit, Commerce Bank, Deutsche Bank talking about these massive buybacks, and it felt like so much of that was coming off of just cash they were sitting on, given kind of this tailwind from net interest income. Does the buyback story end this quarter?
No, I don't think so. I think it has a few more quarters to run, and I think it's for a number of reasons. The first one that versus the expectation at the beginning of the year, rates cut have been few and far between. In fact, we only had one from the ECB so far, waiting for the BOE on Thursday, of course. And on the second point is actually the deposit beta versus previous cycle, so how much the banks return to the depositor in terms of increased deposit remuneration, actually have been a lot lower than in the previous cycle. So the combination of those two factors has been a powerful propellant to the net interest income of all the banks. That's why we see all those banks actually not only confirming the full year guidance, but actually increasing. Unicredit, I think, is a case in point. Yeah. I believe I'm lost count how many times they upgrade the full year net interest income.
Well, okay, so let's macro this out then. When it comes to interest rates, and this is why it's interesting that you say this is a multi-quarter story when it comes to the buybacks, because should we be paying attention to the net interest income or the net interest margin even, given that the expectation is that the ECB is about to kind of hype up and ramp up their cutting cycle?
Yeah, that's the crux of the matter. I personally think that inflation is here to stay, so I don't believe in this disinflationary story. I'm one of the few left in the street.
I was going to say, you are the contrarian there. Yeah.
But I think, inevitably, maybe 12, 18 months down the road, there will be a more focus on the fees and income. And then I think also, and that's, I think it will tail off with the share buybacks inevitably reducing. But I think also, as I said, share buybacks are here to stay for the next few quarters. And then, of course, also will become more a question what the banks do. Who's the best bank position for potentially less revenue from the banking income?
So it's interesting. We're talking about this kind of fee advisory and the fact that, and this is also coming, I should say, in the context of a capital market, that capital markets globally, that it hasn't quite ramped up that I think a lot of people wanted. And it's interesting that the wealth business is offsetting some of the kind of IPO and deal-making business that we're still waiting to see. You see that a big concern in the private markets really talking about that. And yet, there is a concern around loan loss provisions, around cushioning, around some of the capital buffers that are now being required in Europe, even though the United States has kind of pulled back on some of that as well. I'm throwing a lot at you here, but stick with me. I'm also looking at a price-to-book ratio, and this is where Standard Chartered kind of highlighted themselves. Price-to-book ratios that are rising for a lot of the banks. Square all of that for us. If we're talking about caution when it comes to loan loss provisions and capital buffers, and yet the prices driven by buybacks is rising, those feel like contradictions to me.
Up to a certain point, in the sense that especially the European banks, including the UK ones, they were on very depressed price-to-book multiple for a number of reasons versus, for example, Australian, Asian, and American banks. One of the reasons also was the harsh regulatory environment in Europe, in the UK, post the global financial crisis. I think we're removing a bit of this. It's still tough, but it's less harsh than it used to be. And that's why the banks also have built over the last 15, 16, 17 years, in my opinion, huge capital buffer. For example, just to mention one, UniCredit still has 1.7 billion euro of so-called COVID overlay, and I think also another point just to help in squaring this equation, there is also the economy, notwithstanding what we read in the papers, it actually is not that bad as we fear it could be a year ago. So we're talking about...
In the broader European economy? Or
broader European economy. I mean, of course, also we know Germany has... potentially is dropping to recession, but the other parts, Spain is growing 0.8%, Italy is growing 0.2%, of course also France 0.3%. They're not great per se, but I mean it's hardly a very bad recession, which some of us also were fearing last year. So the fact that the economy actually is cooling down, but is still slowly growing, that's explained why the asset quality trend, barring a few specific sectors, for example, construction and commercial real estate, that actually the loan provision has been behaving in line. That's why some of those firms, some of those banks, they're coming out with relatively sanguine full-year cost of risk estimates.
Well, it's interesting that you talk about this in the context of strength in Europe, or the economy perhaps not reflecting or coming at some contradiction to some of that weakness, I think is the point that you just made. Where does cross-border consolidation come in that? And the reason I ask this, and I don't even know if this is in your coverage area, so forgive me if it isn't, but I'm obsessed with the Spanish banking story right now. And the argument that they keep making for this is that the deleveraging story you're seeing in the public finances, specifically in the periphery, in Greece, Italy, Spain, is one that provides more loan opportunity for the domestic markets, not only there, but in broader Europe. Do you agree with that? I mean, that's one of the cases that BBVA is making for Banco Sabadell. It's one of the cases Santander is making for continued outperformance in Spain. Do you buy that for broader Europe?
I don't want to be unpolite, but I think up to a certain point, in the sense that I think consolidation makes sense even in a market like Spain that has done some consolidation over the years. And I think inevitably this is for the step forward after eventually this rate cycle change. Because I think at the end of the day, it's banking, especially in Europe, and Europe remain a very bank centralized market, even though private credit is growing. I think it's the economy of scale is very important. So someone like BBA, if they manage to bag Sabadell, they will grow, I believe, at 24 or 23% in the SME, and that could be a powerful engine for BBVA growth. So I understand the strategic case for BBA is to take over Sabadell. I think in other markets, like for example Italy or France, there is another strong case for having a bit more domestic consolidation. Cross-border will come, but I think also we're still a few years away.
So you mentioned, it's interesting that you say you see the merits of the BBVA deal, because there's so many criticisms that the synergies aren't actually aligning, and this is more of a takeover story than anything else. And we're going to have to get you on to nerd out about that closer to when we get those details. But you mentioned France as well, and this cross-border consolidation story is something that Emmanuel Macron has been very, very vocal about. Walk us through what we need to make that more of a possibility. Yeah, people, they always say it's about the rules, about the ECB, etc. I think also we need a upgrade in the management thinking in Europe. I think also lots of those managers are very good CEOs, but I think also they terms too much in terms of localize. A French bank CEO thinks a lot about France. Fair enough, because probably it's in his KPIs or her KPIs. But I think we need to step up this thinking. Because if you look, for example, at biology, we make a lot of progress in terms of RNA, etc. And I cannot believe that a simple product like the mortgage needs to be so complicated to roll over from France to Italy or from France to Spain or to Germany. I think those are pretty simple products. And I think also with the technology we have, also we should be able to roll these products in different markets. So I don't buy when they say, yes, but we have different rules in France versus in Germany or Italy. A final question to you then. It's interesting we're talking about cross-border consolidation. I should point out that the SocGen CEO was kind of rolling their eyes on it and saying, it's a lovely theory, to your point, but it's not something that's actually doable for that very reason. When it comes to Germany, on a macroeconomic standpoint, we're talking still about Germany kind of being, with the manufacturing, we can still the sick man of Europe, and that seems to be the phrase that Kabin's going to use. It's also incredibly overbanked. There's so many products there. No bank has really been able to go there and make and grow in the way that they can. I think there's something like 1,000 unprofitable banks in Germany. Yeah. Who is succeeding in Germany outside of Deutsche Bank? Who can make that work? Yeah, that's true. But let's remember that 2/3 of the German banking industry is actually public sector, cooperative, and the Landesbank and the savings bank. So that's, I think, the profit is not the main objective of those banks. So I think we need to concentrate on the third, which is the private sector banks, and so the Commerzbank, the Deutsche. I think also some banks, like for example ING, they've been growing mostly on the digital part. Yeah. The French banks are very keen, but the problem with Germany is that 1/3, which is private, is very competitive. Yeah. Everyone is there. The Canadian, the Japanese, the Asian banks, and therefore actually lending to corporate or to consumer, it is not a very profit-enhancing exercise. Yeah. So we need some sort of rationalization in terms of the offer. And also there is a lot of talk of Germany being the sick man of Europe. Rehearsing the playbook from the early 2000s. I think Germany also, unlike the other European country, has a lot in terms of budget because they're the Spartan of Europe. So in theory, if they're willing to, they could unleash a lot of investment into the economy, especially to move the manufacturing to a more, let's say, green pasture. So I think there is a lot of strength in Germany that are at the moment overlooked. A fascinating story. And again, another contrarian view when everyone's talking about weakness there. Filippo Aluati, we have to leave the conversation there. Head of financials over at Federated Hermes. We thank you so much. However, we do continue the conversation on Germany, the third largest economy in the world. That what they're unexpectedly shrinking in the second quarter. We're going to dive into the numbers and what it means for the ECB, given the fact they actually had growth in France and in Spain. We'll dive in. Stick with us. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome to The Pulse. I'm Kriti Gupta. I want to get some of the other stories we're watching this morning. President Joe Biden has criticized the Supreme Court's conservative majority for what he called, quote, extremism in its recent rulings. Speaking in Austin, the president proposed new ethics rules and term limits for justices. The U.S. president said the court's decisions on issues like abortion access had undermined long-established civil rights principles. Now, sticking what's going on in U.S. politics, North Carolina Governor Roy Cooper has withdrawn his name from the race to become Kamala Harris's running mate. The Democrat worried that his Republican lieutenant governor could try to assume control if he left the state. Now, Cooper said in a statement, it's not the right time for him to be on a national ticket. Meanwhile, Donald Trump said he expects to eventually debate Kamala Harris. He had previously declined to commit to appear at a scheduled face-off in September. Now from U.S. politics to U.K. politics, Britain's new Chancellor Rachel Reeves has announced a slew of measures to shore up the U.K.'s public finances. She used a speech in Parliament to accuse the previous Conservative government of running up a £22 billion black hole and signaled she may have to raise taxes to help balance the books.
We have inherited a projected overspend of £22 billion. If left unaddressed, it would mean a 25% increase in the budget deficit this year. I am announcing today that I will hold a budget on October the 30th, alongside a full economic and fiscal forecast from the Office for Budget Responsibility.
Now from the UK budget over to the German economic data, where output unexpectedly shrank in the second quarter, casting a shadow over the resilience of growth seen in the euro area's next three biggest economies. Let's bring a little bit more context into this conversation. Bloomberg's Oliver Crook standing by in Berlin. Ollie, how do we digest these numbers?
Yeah, so listen, we got a lot of numbers today out of Spain, France, Italy, Germany, and they all told slightly different stories. I think we should start probably with Spain because it was really the blowout figure here, where on the CPI data, it came in a lot less hot than had been anticipated, 2.9%. That still feels pretty elevated from the ECB standpoint, but the expectation was for 3.2%, and that's the year-on-year figure. What you really need to pay attention to, Kriti, is the month-on-month, where we saw prices drop by almost 1 full percentage points. In Spain, they dropped by 0.7% from June to July. That is exactly in the direction that prices want to be going. As far as the ECB is concerned, the GDP figure came in quite a bit stronger than anticipated, 0.8%. The estimate was for 0.5%. Similar story in France, not quite as much of a blowout, but grew at 0.3%, about 10 basis points better than had been anticipated. Italy, a little bit more slower, just coming in line with estimates of 0.2% growth. But really, the one that is kind of come against all of that is Germany. We're very sad to say it's the odd man out. It is potentially, again, the sick man. It was supposed to grow by about 10 basis points this quarter. It contracted by 10 basis points. So that's really not the direction you want to be seeing the biggest economy in Europe going to this morning.
Well, Ollie, you talked a little bit about this. You hinted at what the ECB is going to be thinking about. Is this the case then for rate cuts? Are they responding to that German story despite the massive strength you pointed out in Spain?
Yeah, well, listen, I think that they still have a little bit of time to decide. And what I think is interesting is that, we still have the German CPI figure that's going to come a little bit later in the afternoon. That is going to be very closely watched. That's expected to come in at 2.5%. Again, biggest economy, still pretty hot in terms of the number. The headline number for the Eurozone also supposed to come in at 2.5% a little bit later. But listen, what is interesting to me is the sort of dichotomy you have between what the ECB is saying and what the market is hearing. You have Lagarde making it very clear at the rate decision the other week that September is wide open. Schnabel has said that she's very concerned about services where prices are feeling very, very sticky. Nagel, the Bundesbank president, saying that they need to stay restrictive until you hit that 2 percentage point. We are not there yet. Even Guindos, more of a sort of dovish figure, saying that inflation is going to be at the current level through the rest of the year. You hear all of that, but the market is still pricing a 90% cut, a probability of a rate cut in September by 25 basis points. So over the next 2 days, we're going to get a bunch of CPI data that the ECB will be watching very closely. That rate decision is on September 12th. We still get one more print in August, but the ECB is saying one thing, the market is saying another, and it's going to be very interesting to see how that unfurls over the next couple of weeks.
All right, so that's the ECB. Bring it back to, say, the politics of Germany, if we can. The latest there.
Yeah, well, listen, I mean, this is the situation here in Germany. When you see that contraction coming in, it's not something that anyone is very happy to see. And it's very hard to see how the traditional engine of Europe is going to pick up and actually get moving forward. As I said, you had a contraction in the second quarter. The estimates were ranging from, they were dead at the bottom of the estimates of anything that had been anticipated. And we also got the regional CPI data, Crady. So we don't get that print till for another few hours. But if you look across all of the regions of Germany, whether it's Hesse, Bavaria, Brandenburg, Saxony, Baden-Württemberg, all of those inflation numbers went up in the month of July. That is not the direction of travel you want to be seeing. You saw the IFO Institute putting out some research after that GDP figure came out for this quarter, saying that basically the German economy is still stuck in crisis. And by the way, the third quarter is not going to look any better. So what we need to look at are a number of the companies that are reporting in Germany. We have Volkswagen out on Thursday. There'll be something to watch very, very closely. I will try to leave you with a little bit of optimism, though, Crady, from Deutsche Bank, where the company that really lends to many of these manufacturing companies that have been in a manufacturing recession for 2 years now, saying that maybe, just maybe, they've turned the corner. Have a listen to the CFO.
Loan growth has been more sluggish than we would like to have seen. We'd been anticipating it a little earlier than now. And that's true also in Germany. We still have had a net decline in our mortgage book, for example, this quarter. Some of that's deliberate, some of that's sort of the market environment. Mm-hmm. I'd say the German economy has found its footing, and so we're seeing growth now. It's marginally positive, but we think accelerating now in the second half and into 25.
So, Crady, despite all the pessimism and some of the really poor surveys and data out, at least potentially in the future, the Deutsche Bank sees maybe that the German economy has found its footing.
All right, Bloomberg's Oliver Crook giving us a little bit of optimism on a relatively doomsday day in Germany. We thank you so much. Coming up, we're going to see if that vibe continues from the macro to the micro. We're going to talk about U.S. tech earnings next. Stick with us. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So we covered the politics, we covered the macro. Let's talk a little bit about some of the other earnings stories we're watching, not in Europe, but across the Atlantic, and get more on the tech story. Bloomberg's Tom McKenzie all over that. Microsoft in focus.
Yeah, in focus for today. And the focus for Microsoft, it comes down to the cloud business. So Azure, to what extent is that going to perform well? Now, expectations are that they're going to come through with growth within Azure, within cloud, of about 30% for the most current quarter. Top line revenue is expected to increase about 15%. But here's the context, as you know well, Kriti, in line gains in terms of earnings, an in-line level in terms of the numbers that come through will not be enough for many investors because the expectations are so high. And then there's a question about monetization of AI as well. Look, Alphabet did pretty well on cloud. That suggests that Azure's performing fairly well. But again, are they able to properly monetize the investments they're putting in place? That is another key line. Watch the CapEx, watch the spending on AI. Expected to be $13.3 billion. Above that could pose a challenge.
All right, the pain of being an A+ student, apparently. We'll see if Microsoft wins that battle. Bloomberg's Daybreak Europe anchor Tom McKenzie, we thank you so much for giving us that crucial context. Up next, the conversation continues. Bloomberg Brief with Danny Berger and Manus Cranny leading you up to the New York stock market open. Stick with us. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Countdown to decision day. Futures gain. The yen weakens as the Fed and the BOJ begin their two-day meetings. Meanwhile, Microsoft kicks off the week's Mag 7 earnings. The focus this time, return on AI spend. And a $3 billion unwind. Berkshire Hathaway cuts its stake in Bank of America for the third time this month. Good morning, Manus.
Danny, a very good morning. Are you nervous? Everybody's nervous. Don't press the buy button on Microsoft unless you're really, really strong and bullish. A little bit of breaking news for you, Danny. We've got Eurozone GDP comes in at 0.6%. The estimate was for 0.5%. So better on the pan-European number, but Germany disappointed, down 0.1%. The bulwark, the core of Europe, is underperforming relative to Spain. Citiground downgraded China's growth yesterday, 4.8%. We're in a growth question mark, maybe even a growth scare. We'll talk more about that in a moment. And in part, that takes you down on the Brent price as well. You've seen Brent at a 7-week low, losing 3% over the past 2 sessions. And as I say, it is about global growth that is the drag there. And Bloomberg commodities are down 6% in July. Now to the NASDAQ. Everybody can breathe because we're getting ready for $10 trillion worth of market cap to be delivered. Microsoft is the name on the board. The nerves are being tested. We're almost in a correction, down 8%. Deutsche Bank say this. Growth, tech growth, has been extremely strong. It's moving from extremely strong to merely strong. Equity positioning is at a 2-month low. And then when it comes to the bond markets, everybody breathed a little sigh of relief yesterday. The funding needs from the Treasury dropped to $740 billion from $847 billion. That was pretty much expected. But also in there, the Dallas Fed numbers coming in at negative 17.5. And TD warned, take your profits on your bonds because there are lofty FOMC expectations. Danny, good morning. Are you nervous? Never nervous.
When you have a fifth of the S&P 500 reporting in just 4 names this week, of course, it's hard not to be nervous. But I think the way Deutsche Bank put it, Manus, is a really valid way to do it because earnings expectations are not as high, but they are still high. If you take it out quarters to come, we're expecting 20% or just about earnings growth for the Mag 7, save for Apple. That is a huge bar, and you get the feeling this week after Alphabet last week that it's going to be harder to impress than it is to disappoint.
It is, and the range of disappointment is going to be in the capital expenditure in terms of the hyperscalers, and we know that. Just the concept, Bespoke Investments sent out a piece yesterday, I think, which frames the narrative very nicely, which is what is irrational exuberance and where are we? And they look back to 1994 when we got the very, very first web browser, Netscape, and they looked at ChatGPT and Netscape and where we are. And we're still 4 months away, technically 4 months away, from when Alan Greenspan talked about irrational exuberance, and then we went on for another 3 years. Go on the tech.
And you could make the argument that it was easier to adopt the internet, as we talked with Torsten Slok about. You just sign up for a web browser than AI. Listen, I'm really interested for Microsoft today because I was looking at the SPLC function on the terminal. Meta, Microsoft, Alphabet, and Amazon make up 42% of NVIDIA's revenue. Microsoft alone is 20%. If they don't show up today, then NVIDIA has a big problem. If they start talking about pulling back on some of their CapEx, this just comes straight back to NVIDIA. It's a concentrated market. and their revenue is very concentrated.
And the other story, we'll touch on this in a moment, Samsung making up ground in terms of the ability to deliver some of those chips to NVIDIA, and that in some ways takes a little bit of heat out of the supply chain. It's just another part of the narrative.
Right, totally. Okay. Wisdom Tree's Anika Gupta weighs on that big week for earnings. She writes, quote, a risk of returns being so concentrated is that when those companies fail to meet expectations, their performance suffers. Forward earnings growth looks set to expand beyond the current leaders. Anika joins us now. She's the Director of Macroeconomics Research at Wisdom Tree. Anika, great to see you. It's been far too long. Listen, from reading that there, you sound like someone who wants to buy the other 493 names.
Absolutely, Danny. We are seeing that rotation take place. It's been quite a fierce rotation out of the large caps into the small caps. And I think there's been a number of catalysts bringing about that rotation. First and foremost, we're now seeing a higher probability of those rate cuts being priced in by the Federal Reserve. And this has been on the back of softer inflation prints. And at the same time, we have been seeing a bit of risk on the upside to the labor market in the U.S. And I think the culmination of expectation of easing of interest rates in the U.S. alongside the narrowing of earnings gap between the large caps and the small caps is also aiding, the small cap sectors.
Anika, good morning. Look, it depends which research house you read. There's Laurie Calvasina and a number of others saying, don't rotate now, the earnings aren't there in small caps. My question to you would be this. You talk about the concentration. We know the concentration is in the Mag 7. It's the most concentrated, you say, since the 1970s. So here's the risk reward. Do I trim back my Mag 7 exposure, or what is the danger in doing that? I know we had a leg lower from NVIDIA last week by 9%, but is it trim the Mag 7 and actively add on the broader names?
Yes, it's very much adopt a bit of a barbell strategy where you hold on to your existing exposure to large cap tech, trim a bit, and within that exposure, if you trim a bit of that and add on to a bit of an exposure within small cap value and small cap quality, that would just broaden out your exposure and keep it a bit more balanced, as opposed to having this narrowing breadth, a narrowing concentration within the U.S. equity market. I think that would aid investors, especially given the change in the broader macro scenario that is playing out.
I think one of the things that caught a lot of people by surprise last week, Anika, wasn't necessarily just that big cap tech unwound, because so many people have been calling for that. It's the fact that basically every consensus position was punished last week. And a lot of folks have been pointing to the rapid appreciation of the yen, saying that it caused ripple effects. Do you worry about some of that correlation in markets, that faraway markets like Japan and the yen can have such an impact on big cap tech?
Absolutely. I mean, right now, we know we are seeing an over-concentrated position where investors are essentially net short the yen versus the US dollar. And that has been predicated on the wider interest rate differential between the US and Japan. And clearly that is beginning to narrow. As we've seen expectations for Fed rate cuts being priced in, that gap is narrowing. We also have the all-important Bank of Japan meeting. And there is a higher probability that the BOJ increases rates by 15 basis points today. And I think that is also playing out into this appreciation that we've seen in the yen alongside the intervention that we've had from the Bank of Japan. But I think it's very important for investors to keep in mind, the conservative outlook that Japanese corporates have put forward. Japanese companies for financial year 24 have actually put out a very conservative estimate for their forecast for yen dollar, which is at 144. And already in between April and June, we had quite a bit of a quite strong correction and an easing of yen versus dollar. So that's given Japanese corporates a bit of a reserve. Even after we've seen this recent appreciation in the yen, I would say, Japanese companies still don't need to, cut short on their guidance, and that's because for companies to change that initial forecast that they've kept of 144, we'll have to see nearly 3 more quarters into the financial year 24 showing a much stronger yen, and that's unlikely to take place. And that's why we still believe that Japanese corporates are in a strong position to weather out the recent appreciation that we have seen in the yen versus the dollar.
And you make that point really clear, is that the appreciation in the yen, it's a recovery in real wages, it gives domestic households a purchasing power, so the domestic story remains in track. Look, let's just close off very quickly. We've had McDonald's with a drop in terms of spending. We've had Heineken pressures here in the United States of America. Diageo pressures again in terms of transferring to lower branded whiskies. A favorite phrase of ours on this show is about the exuberance of the U.S. consumer. What is it? The
hedonism.
The hedonism. Thank you, Daddy. The hedonism of the U.S. consumer. When you read Heineken, McDonald's, Diageo, do you worry that we're now jumping off from a growth question to a growth scare, and perhaps cracks in the consumer really becoming manifest?
There's no denying that we are seeing a slowdown in the economy. But what's important to keep in mind is that so far we've had a numerous amount of headwinds hit global equity markets, and they've been able to weather the storm. So now that we're seeing this slowdown take place, it is coming at a time where we're also likely to get the easing of monetary policy globally. And hence, while we will end up seeing a bit of a slowdown, I think the global equity markets will be able to weather the headwinds that we're facing with the global growth slowdown, alongside a much faster pace of monetary easing by central banks globally. And that should also help bring about a bit more momentum as we head into year end for equity markets.
Well, let's see whether the Fed's actually listening in and taking heed of former Fed governors and yourself, Anika Gupta there of Wisdom Tree. Get ready for that cutting cycle. Other stories on your Bloomberg terminal. This is what we got for you. BP maintains the pace of its share buybacks and increases dividend after posting strong results in the second quarter. The British oil major reiterated that it will purchase $3.5 billion worth of shares and greenlit an oil project in the Gulf of Mexico.
Manis, here's one of the stories you mentioned, that a slowdown in Latin America, the Caribbean, and the U.S. have all pushed British distiller Diageo to its first annual sales decline since the pandemic. CEO Deborah Crew told Bloomberg that U.S. consumers were indeed reining in their spending.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies. We're calling it a cautious consumer, a U.S. consumer that's quite cautious in spending. Wallets are under pressure as inflation is persisting. You're seeing, 30-year high grocery, food basket prices, and that has certainly impacted us. Additionally, interest rates remain high, and so that's impacting retailers. We've had some retailer destocking this year.
As we've been saying, France and Spain each delivered growth that beat expectations in the second quarter. Both countries matched their first quarter growth rates and exceeded the median forecast of economists surveyed by Bloomberg. The French report only partially captures the impact of the country's snap election.
Coming up, Berkshire Hathaway has unloaded $3 billion of its stake in Bank of America in just this month alone. We're going to have more on that next.
And the Fed should have already started cutting rates. That's according to Mads Peterson of Human Edge Investment Technology. He joins us later this hour on why he's long of equities.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Menace Cranley alongside Danny Berger in New York. Now, Berkshire Hathaway has just cut their holding of Bank of America. It's for a third time this month. That's a total of $3 billion unloaded by Warren Buffett's firm. Charlie Wells is standing by with the narrative. I just wondered to what extent is this, I've had a great run, I've put $5 billion in at the start, I've had a monster dividend, the run is done, or is it something more significant about a call on banks? Charlie, good morning.
Good morning. I mean, Manus, this feels a little bit like a summer trim. I think we see that $3 billion figure and we think, you know, huge amount of money for pretty much any person except Warren Buffett. Now, this is Berkshire's biggest pullback from Bank of America, but they still remain, you know, the largest holder of Bank of America. Their share is worth about $40 billion there. But of course, you know, this is sort of value investing 101, Buffett getting in back in 2011. Those shares from that point are now up 488%. So if he wants to take a little bit of a trim, I think we can let him.
Fair enough, Charlie. And of course, like the genesis of the story, that he's in the bathtub after the financial crisis and he decides to buy Bank of America. And Warren Buffett has been someone who's really invested a lot in banks in general. But in the past few months, Charlie, we know that Berkshire reworked some of its banking holdings. Is there some sense of it's not just Bank of America, it's banking that Berkshire wants to change?
Danny, that's a great point. I mean, they do tend to make these kind of tweaks around the edges, and what's striking is it can feel a little bit like banks may be at something of a pivot point. So they had a really good first half. We're kind of just about done with global bank earnings. That KBW Bank Index is up, I believe, about 19%. But in some of these earnings, you see a really positive story for that first half. Deals coming through. You see net interest income holding up fairly well, but there's uncertainty ahead. A lot of those deals have been prearranged. There's questions about rates and how long loan demand can hold up. So if you're looking at banking, you've got $3 billion of evidence that a value investor that everyone knows it was willing to kind of take a little bit of, potentially take a little bit of profit now ahead of some uncertainty.
Yeah, I mean, but everyone else in the market has been going gangbusters on especially these regional banks. Charlie, we appreciate it as always. Charlie Wells there. Okay, let's turn to tech. 4 of the Mag 7 report this week. It's Microsoft after the market close, followed by Meta, Apple, and Amazon through the rest of the week. That represents a fifth of the market cap of the S&P. But a market rotation has seen the Mag 7 shed over $1 trillion in market cap in the past 3 weeks. Let's get over to Bloomberg's Tom McKenzie to walk us through it. Tom, we had Alphabet last week, a disappointment. So when it comes to Microsoft, can they really show up in anything that will set their earnings, set their share price higher, or do all we care about is what they're doing with AI?
I think that's where the focus has got to be. Look, there's a read across from Alphabet for Microsoft and 2 lines that tie in from Alphabet to Microsoft. One is on the cloud business. Alphabet performed well on that front. Expectations are that Microsoft is going to come through with growth of about 30% for cloud and for Azure. So watch for that. The other line that you can tie and link from Alphabet to Microsoft is the CapEx, the spending on that AI infrastructure. And that's where the concern was for investors in Alphabet last week, despite the top line beat on the earnings earnings story there. Microsoft expected to ramp up its spending from about 11 billion to 13.3 billion. Anything above that could cause jitters. Analysts telling Bloomberg, look, inline earnings, inline results for companies like Microsoft, not good enough. They're not going to be good enough for investors out there. They need to come through with a solid beat. So watch cloud and watch the spend on CapEx around AI.
Yeah, well, inline is mere bagatelle. It just doesn't deliver. Look, talk to us about AMD. Chipmaker has been lagging its peers. You could say that. Just looking at the quarterly results so far, hardware and semis quarterlies beats. You've got 8-1 beats so far. AMD's got a lot of work to do today to convince us, haven't they?
Stock is down 5% year to date. It is a competitor to NVIDIA, but the gulf, as you suggest, is wide in terms of that moat that NVIDIA has carved out for itself. What I'm going to be watching from AMD is whether or not they raise their sales forecasts around GPUs, the graphic processors, the AI accelerators. Currently, they set themselves a target of about $4 billion US. That is just a fraction of NVIDIA. If they raise that target, that, of course, will be welcomed by investors. They got the PC part of the business, they got the service part of the business, they got the gaming part of the business, but the focus for AMD will be on those GPUs, whether they can build out that market share and start to nip at the heels of NVIDIA.
Well, there's one thing taking market share from NVIDIA. There's another thing being tapped as the person that can make those chips for NVIDIA, and Samsung is making some breakthroughs in the chip space too. Samsung has been a company that has really lagged. It's seen smaller rivals catch up to it. Is this a sea change for them?
Yeah, this has been an embarrassment, frankly, for Samsung, which is the world's largest maker of memory chips. As you say, they've faced that competition from SK Hynix and others. They are behind when it comes to that. But you're absolutely right. NVIDIA basically has come out and blessed one of their latest memory chips, the high bandwidth memory chips that they produce, the HBMs. So that is a significant positive for a company that now is on track, it seems, to try and close that competitive gap with SK Hynix. So we are going to be watching that from the results coming out from Samsung. The expectations, by the way, top line, is that you're going to see a jump in net income from this company, the largest jump in at least a decade.
Well, all eyes down for that. I mean, that high bandwidth memory business is going to go from, what, $4 billion bucks last year to something like $70 billion in 2027. So being right and being well positioned in it is critical. Tom, good to see you. Tom McKenzie on the tech agenda. Coming up with Danny and I, a look ahead. The rest of the headlines around the world. Governor Roy Cooper drops out of the race for VP. Context matters on Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that, moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Wait.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
It's your Bloomberg Brief on this Tuesday. Danny Berger alongside Manus Cranny in New York. Okay, let's go through some of the front pages this morning. A look at what's making headlines, Manus. The Washington Post has this on their front page, that North Carolina Governor Roy Cooper has pulled out of the race to be Vice President Harris's running mate, writing on X, "I was honored to be considered for this role. It just wasn't right time for North Carolina and for me potentially to be on the national ticket." He was never really vetted. He didn't allow himself to be part of that process. Harris is expected to pick her running mate by next Wednesday, August 7th.
Yeah, let's see if it is a swing state that makes it into the race with her. Next up, protests erupting in Venezuela. This is as the nation has denounced the election results. Maduro's government ejected 7 diplomatic missions and Latin American countries that condemned his claim of victory, which he made despite the reports of fraud, Danny. The opposition leader claimed to have evidence that Mundo Gonzalez won the election over Maduro.
And on the FT, I found this story so interesting. Essentially, Amazon's Prime is going to be charging a cheaper rate than Netflix for advertisers. And this is a big deal because the competition is crazy in this market. If you think about all of these streaming platforms, most of them have an ad-based platform on it too. Apple is supposedly going to have one soon. But Amazon is so interesting, Manus, because they know everything about us. If you're an advertiser, you would love to give money to Amazon. Not only is it cheaper, but they know I like to buy, I don't know, expensive toothpaste so they can target me with expensive floss, I guess.
Now we know what Danny does on Amazon Prime and has delivered.
It's the best.
Look, I think this is about the commoditization of advertising as well. It's a high margin business. Citi reckon that this could add like $5 billion to their numbers. And if you think about it, they've already got some advertising revenue streams. That's at nearly $12 billion. So this is about going head to head with everybody else and the commoditization of those rates. And we're in one way that happens in advertising when you commoditize the rates, and it's usually a little bit south.
Yeah, it's a race to the bottom, and it's a problem for Netflix because in their most recent earnings, they had space to sell. Yeah. They hadn't sold up all of their ad slots, and their argument was, look, we have a lot of people on our platform now, the ad-based ones, so you should give us money. What happens when there's a cheaper option out there?
Well, I'm waiting for our Apple Plus to introduce their adverts and interrupt my viewing. They're coming up. We're going to talk about how long you want to be of this tech market with Mads Peterson.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google public, so I had a little sneak preview.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Countdown to decision day. Futures gain and the yen weakens as the Fed and the BOJ begin their deliberations over the next 2 days. Microsoft kicks off this week's Mag 7 earnings. The focus, return on AI spend, and a $3 billion unwind. Berkshire Hathaway cuts its stake in Bank of America for the third time this month. Danny, good morning.
Good morning, Manus. So in a little under 5 hours, we're going to get JOLTS data. Then after the market, we'll get Microsoft earnings. Plenty to keep us busy ahead of both meetings from the BOJ and the Fed. At the moment, S&P 500 futures up about 0.1% after barely eking out gains yesterday. So that rotation trade takes a breather. Russell also falling yesterday. Now it's the turn of earnings to show up. Your 10-year yield, that has barely changed this morning. 418 is where we stand. One thing that is helping take some of the pain out of this bond market are commodities. Manus, you pointed out this to start the show. The Bloomberg Commodity Index has erased all of its gains for the year. We are now flat on that. So that also helps really push forward this rate cut story. Meanwhile, the yen turns from appreciation to declines, dollar gaining about 0.5% versus the yen. Simon White from MLive has this fantastic statistic. Yes, the data sample is small, Manus, but out of the past 10 meetings, every time Ueda has spoken, the yen has fallen. There has yet to be a BOJ meeting with Ueda at the helm where you see yen appreciation.
Yeah, it's not going to be a debate getting through that 150 level. And a lot of people have said, look, that's going to be very, very difficult to do. I think you're right. When it comes to the growth outlooks, overall Europe, actually beat on the estimate, but Germany was the drag. And then you reflect back 24 hours ago, we got a breaking headline from Citi that they were downgrading China growth to 4.8%. And that explains in part the pressure that you've had on commodities, which is actually all pretty good news for a central bank out there. If oil is on the downside 7-month low and commodities give up this year's gains, it's just another layer in the cutting cake. It's not the closer,
yes,
but it's there.
But you get this feeling that we are walking just such a fine line because you look at those things, you look at slowing global growth and the appetite for commodities, you say, that's great, it means the Fed can cut. But at some point, you need to be concerned that that slowing turns into actual slowing growth enough that you get concerned. For the moment, this is a market pricing a soft landing. Things are going to slow to a perfect amount, and we can get through it, and small caps can rally, and everything will be wonderful. But you hear from all these former Fed officials writing, like Bill Dudley, for example, and Alan Blinder, saying that maybe we're walking a finer line than this market is appreciating.
Yeah, and that's their point, which is, cut earlier. There's a wonderful saying at home in Ireland, which was about voting. Vote early and vote often, which is cut early and not necessarily cut often, but make sure you've got the right amount of cutting because rates are tight. Real rates, according to a few people out there, are a little bit tight and restrictive. Let's shift the agenda along. You're right, we're kind of down to this growth number from Microsoft. What are they spending on CapEx? Mads Peterson is our guest for the next couple of minutes over Human Edge Investment. And as far as technology is concerned, this is what he says. In our dynamic allocation strategies, we're fully invested in equities. That is 100% versus 60% in the benchmark. We're focusing primarily on large cap growth stocks, maintaining our preference for U.S. equities. Mads Peterson, good morning. The world is focused on the Nasdaq. We're on the brink of a correction. We've got dynamic movement in portfolios from large tech, rotation into the Russell, etc. And yet you are committed. I've never read a more committed note. Fully invested in the dynamic portfolio, 100% in equities. Why are you so bullish and committed?
Well, thank you very much for inviting me. I think I'm most often quite committed like this, maybe 70% of the time. So it's not quite as unusual, but let me give you the reason. We've had a sell-off in equities, which is extremely small compared to the almost 100% gain in S&P the last 5 years in total returns, including the dividends and buybacks. We are seeing a situation where earnings have been extremely strong the last 3 quarters, 4 quarters, and the last 3 years. And we are seeing that the technology companies, which are increasing in cap, are also now the largest sector in terms of earnings. So they're actually transforming people's optimism into real growth. Yeah. So we're basically just saying the US financial market will stay great, and this is where we want to run the risk. We run risk for our clients to get them good returns. And we definitely hope Microsoft will report well tonight, but we notice that the reporting season so far has been very positive, and the last 12 months of earnings are up 12%. So it looks good on the surface, and then there's a lot of things to worry about, which we can then talk about.
Should we talk about the things to worry about then, Mads? I'll take your optimism and sprinkle some concern in there. Because you do look at some of these earnings, sure, on a headline level, it looks good, but you have issues like the airlines, the autos, the consumer stocks, something like McDonald's too. It's sector by sector exposed to the consumer that's reporting some pains, reporting that there is pricing fatigue. How much do you look at that and say this is a wholesale issue, or it's some of these individual companies having problems and not adapting quick enough?
It's a real issue, and it's especially a real issue for the consumers. But it's not a secret that the world has become more unequal or uneven the last 10 years. These are not the companies which drives the global spending. McDonald's is an extremely famous company, but they don't have a humongous investment budget which drives profitability of global markets. So what we have seen, which has maybe drowned a little bit in the story, is that a lot of the European strong companies like LVMH, like Novo, like some of these growth companies have had issues with different things, but primarily the concern here is the Chinese consumer, because if China doesn't get going, then Europe can fall off. I'm not very concerned about the US consumer. Look how much house prices are up the last 5 years, how much wealth has been gained. It is painful for the average consumer, but the average consumer is no longer driving the world economy.
You say China is perhaps one of the most underestimated risks. Citi downgraded their growth yesterday. They're just one house, Mads. Some people would criticize what's piecemeal response mechanism in small rate cuts and not enough to bolster the consumer. Why would you describe it as being the most underestimated risk? How bad can that get?
It can get really bad. It can get so bad that Europe goes from recession to depression, because what we are seeing now is that the German companies and the European growth companies are disappointing. We saw Heineken take a big write-down on their assets in China. So what if US falls into a temporary recession? Then Germany has no external growth. Then Europe has no growth. Germany didn't grow, as we just saw this morning in the GDP numbers. We get a recession. Then you have to reprice real estate in the European real estate funds. They have to sell real estate, which is already declining. And we're back to the euro crisis. So it can be pretty bad if it goes all the way like that.
Okay, if that's Europe, you say in the US, the Fed should have already started cutting rates. There are two different opinions of this, Mads. Let's just take the op-eds we've had from former Fed officials. You have Bill Dudley, who says they are increasing the risk of a recession by not cutting this week. Then you have Alan Blinder, who says, no, it's not necessarily that it's an increase of a risk of a recession, just all the stars have aligned, and therefore they should cut. Which side of this do you stay on, Mads?
I stay on Bill Dudley's side, and I hope he says the same when he's a member of the board at UBS, so that they don't get into the problems they usually get. We hope they will survive better next time there's a crisis in the US. But what we really hope is that they will realize that there really is no need to keep rates so high. Inflation is coming down nicely. It's not coming down in a straight line, but when did a macro number last come in a straight line? You know, and rates don't need to be so high. They can just cut 25 basis points on the next 3, 4, 5, 6 meetings, and we can land at 3.5. That would be nice and smooth. We don't expect they'll do it this week, but that would be a nice and smooth way to take away a bit of the pressure, because a lot of the U.S. economy is not doing as well, and we can maybe even get a rotation in the housing market.
Now, come on, Mads, we'll put it back at you. You're the one that said that nothing ever goes in a straight line and that nothing's ever exactly as you see, as it seems to be. You're talking about a pretty hefty cutting cycle there. A lot of our guests have said to us, it'll be a tweak now and a very much a delay. So are we in policy error? Does that matter? Does that phrase matter? Are they behind the curve? Are they in policy error in your view?
If we were ever in policy error territory, the only place where we are more in policy error than in the Fed is obviously ECB and the whole Chinese policy framework. Yeah. So we are deep into a fascinating global boost to growth from technology and a fascinating area where we need to take notes of every central bank meeting to see what we can learn of the mistakes they're making at the moment. So yes, we're deeply into it, and the Fed should cut 25 and the ECB should cut 50.
But Mads, this is the complicated thing is, if you take us back to the start of the conversation, you even kind of mentioned it there, you could build a case for them waiting. As you say, technology investment is driving so much of this economy, and that's still happening strong. You look at some of the headline data, GDP for the US, that came in stronger than expected, as did retail spend, as did PCE figures, Mads. So what's the rush? What's the difference of a couple months?
Well, the rush is that when you stay in tight territory, you don't know where things will next break, and you don't get the growth to widen out as it should. So you have this awkward situation that basically the boomer generation, they're sitting on enormous wealth gains in equities and houses, and the younger people cannot get into the housing market. Why not start working on this? And the younger people are not like young, yeah? It's like people, almost people my age. I don't claim to be young, maybe 10 years younger than me. You know, it's not like that. It's just take this generational change and move on with it, and ease some of the pain in the lower end of society instead of trying to strangle it. There was a policy mistake done before by being too easy too long. Don't redouble your policy mistake by being too tight too long.
You're telling me you're not Gen Z, Mads?
It's a fear of forecasting.
And can I just clarify? Really. I'm not a boomer. I just want to put that out there.
Good clarification, Mads. It is always such a joy to catch up with you. Mads Peterson of Human Edge Investment Technology. Come join us again soon. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Brief. I'm Manus Granny alongside Danny Berger in New York. We're counting down to the Microsoft earnings. They're on deck after the market close. Here to take us through what to expect, it is Tom McKenzie. Tom, it's CapEx. We just had a very bullish conversation with Mads Peterson in terms of the allocation to tech. He's all in, and it's going to be a pretty big growth momentum that's delivered. But this is going to be about CapEx today from Microsoft, isn't it?
It really is. Look, last quarter they came through with an uptick in terms of CapEx. All of that, of course, or at least the majority of it, focused on that artificial intelligence infrastructure. So the chips, of course, the GPUs for NVIDIA, but also the data centers in which they sit, of $11 billion US. That is expected to move up to $13.3 billion. If it stays within that range, possibly a comfort area for investors. Much above that, though, could cause concern. You saw that reflected in Alphabet last week when their CapEx spend came in higher than many had expected. So that's going to be key. The cloud computing part of the business, of course, it ties together because it sits on that data center. So Azure, that is expected to see pretty decent growth, upside of about 30% in terms of the revenues that come through for cloud for Microsoft. So those are the two key areas to watch for, is that CapEx spend, is the demand for cloud. But again, as one analyst who's quoted by Bloomberg has said, in-line results will not be enough to assuage investors. You need to have a really solid beat and expectations that, you know, in terms of that spend on AI, they are able to close the gap in terms of the spend and the monetization.
And Alphabet is maybe the poster child for that. You had solid cloud results, you had inline, and yet the shares fall. And Tom, I think it's easy in this week to get caught up in the idea that we have 4 of the Mag 7 reporting, 20% alone for market cap. But we can't forget that chip makers are also reporting. We get AMD today. How much are those reports also going to set the tone for this tech earnings season?
I think AMD is really fascinating. This is a stock that's down about 5% year to date. That compares to 60% gains year to date for the semiconductor industry in the S&P in terms of that component. So that's the comparison. There's a lot of catch up for AMD, and the focus for them, the scrutiny, will be on their AI accelerators and whether or not they are able to ship more of those than has been expected, whether they're able to close the gap with NVIDIA. They've guided for this year revenues around those AI accelerators of around $4 billion US. Cantor Fitzgerald says if you see a number closer towards $5 billion, if they revise it up to around $5 billion or closing into $5 billion, that will be very positive for this stock. But there have been rumors that Microsoft has pared back some of their orders for AMD's AI accelerators. Just rumors for the moment, but we'll see if that gets confirmed in these results. They don't break out the AI accelerators within the earnings document, by the way, so you'll have to listen into the call for the details on that.
Tom, thank you very much. Bloomberg's Tom McKenzie there on tech earnings. Other earnings out there, Airbus, it will report results after the European market closed. The plane maker did issue a profit warning last month, citing continued supply chain constraints. We're also going to hear from Boeing tomorrow. Joining us now is Sid Phillip, who helps lead our airline coverage. Sid, the airlines themselves, let's set aside the plane makers for a moment. They've reported earnings that have showed a slowdown in demand from consumers, when previously we thought the issue was that they couldn't get their hands on enough planes. So let's bring the plane makers back into that. What does it mean for them to have these airlines all of a sudden in a position of overcapacity?
Morning, Danny. So yeah, for the airline industry, obviously there is an overcapacity problem in certain markets. We've seen that happening in the US. We've seen some European carriers also talking about issues with yield. And it hasn't yet boiled down to airplane manufacturers because Airbus and Boeing both have backlogs that stretch well into the next decade. And so for them, essentially, they're sort of struggling to produce enough planes. I mean, Airbus has talked about how supply chain challenges have forced them to cut their annual delivery target to 770 this year from 800. And essentially, we're looking for any commentary on how the supply chain is doing and how Airbus will be able to sort of get by these supply chain issues and actually be able to ramp up production to where they want to be. And on Boeing, again, we've sort of seen Boeing slow down production as they get into the whole, as the FAA restricted them from raising production in the aftermath of the door plug blowing out in January. And so, again, we're looking to see what Boeing talks about in terms of how they can get production up and get those deliveries going, because deliveries are vital for cash flow, and both manufacturers desperately need the cash.
Well, I can verbalize for you the frustration in the airline industry. A guy caught up with the Fly Dubai CEO. This is a moment of pure frustration. They're waiting on 10 MAX aircraft. They only got 4 of them. Whatever our patience has been, this was way too much. This will have a major effect on operations. So we're all going to pay the price at some level on these delays. You talk about what we're going to focus on from Boeing. Until those restrictions are lifted, how much more pressure is there on the cash burn that we saw in the first half of the year relative to what's going to happen in the second half of the year, which is critically important to the US banks?
Absolutely. I mean, so Boeing has burned through about $8 billion in the first half of the year, and they desperately need to get cash going again in terms of deliveries and get sort of be able to ramp up cash generation in order for them to sort of meet those annual targets, and as they can sort of come out of the hole that they're in at the moment. Because, I mean, Boeing's had a sort of run of bad luck in terms of they've had issues with 787 deliveries, they've had issues with 737 MAX and production, and they sort of desperately need to get their production and deliveries going again in order to start generating cash and essentially meet their targets.
Very generous description, Sid. A run of bad luck. Other people might be a little bit more aggressive. Sid Phillip there on the very latest for the airline industry. Let's pivot to the banks. Standard Chartered, the stock is romping up this morning, up 6.63%. They've announced a $1.5 billion share buyback. Let's listen in to Bill Winters, the CEO.
What we've said to shareholders is we've got a strategy. We're pursuing the strategy. It's working quite well. Earnings are strong. We're managing our capital very, very directly and I'd say quite actively. And that's allowed us to return any surplus to shareholders. And we said, especially given where our stock price is, which is not as high as we think it should be, we will buy back as many shares as we can with surplus capital. That's what we're doing. If we keep on performing, of course, we can keep on buying back shares.
Bill Winters there in his 10th year at the bank and one of the longest-serving CEOs of any major UK lender. Charlie, good to see you. This is about delivering on the Fit for Growth narrative, the big rip-up the bank program that he has had. I'm hearing a lot of internal angst at the bank. So is this a soothsayer with a buyback for the market?
Certainly. I mean, he was looking quite chipper in that interview. And I mean, one of the really positive stories to come out of this report was wealth. And this is the sort of story that any bank would be envious of. Operating income for wealth was up 25% for Standard Chartered for wealth. So that is certainly something that they're looking to bolster as we go into an era when rates could be coming down, hitting other parts of the business. But of course, investors were razor focused this season on expenses. And that Fit for Growth was a plan, not just to cut expenses, but what was interesting in Winter's interview today is he talked about some of the structural changes that they've tried to make. They've stripped out management layers across the globe, and that could be causing some of that consternation, Manus, that you're talking about.
If we zoom out, Charlie, one of the other big stories this morning is Warren Buffett cutting his stake in Bank of America by $3 billion, cutting it 3 times in the past month. We just finished bank earnings. I know we also got Nomura earnings that beat today. I wonder if we look at something that Buffett did and say maybe it's not as good as it is out there, as many people think it is. Should we read anything into it like that?
I like that skepticism, Danny. And I mean, look, you look at the charts for these major banks and they've been outperforming the S&P, the KBW Bank Index is up. And so, you know, I think there's something of a contrarian take here that, look, the results have been good. We're seeing, you know, deal flow healthy again. We're seeing, you know, markets businesses doing well. But how long does that continue? I think one of the really striking points that our opinion columnist Paul Davies made was that a lot of these deals were clocked already. They were expected expected. And so what does the deal flow look like going to the second half? What do markets look like? And what happens with not just this rate uncertainty, but also the political uncertainty that we're facing in the United States? That could all play a factor. And I think if there are investors who are looking at this as something of a pivot point, they may have a point.
Fair enough. Charlie, appreciate it. Charlie Wells there. Okay, coming up, we're going to set you up for the trading day. We have a lot of earnings, a lot of data. We'll get a little bit of jolts, a little jobs. That's to come.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, let's get you set up for your trading day on this Tuesday. We're going to get a lot more earnings. Another about a third, I think, reports this week. Before the bell, we're going to get reports from PayPal, Pfizer, and Procter & Gamble. And then we're going to get JOLTS job openings and consumer confidence data, those at 10 a.m. Eastern time. Plus, the big one comes after the bell. That's Microsoft. It'll also be accompanied by AMD after the market close. So plenty to chew over, Manus, before we get those Fed and BOJ decisions.
Yeah, a couple of small movers, Danny. I mean, there's a little bit of nervousness ahead of the Microsoft numbers, but this is what we got for you. CrowdStrike, they slide. The report is Delta is looking for compensation. Lattice Semiconductors, chipmaker, where revenue forecasts came in below the estimates either in the market, and of course, we're counting down to Microsoft, and I think we said this a couple of times, which is it's going to come down to the capex, it's going to come down to the belief in the monetization, and they're maybe a little bit further ahead when it comes to the monetization with their product in the cloud.
I don't think we should overlook its impact on NVIDIA. 20% of NVIDIA's revenue comes from Microsoft, so if they don't show up, it could knock down one of the stars of this market.
Yeah, and we're counting down to BOJ and the Fed. Good morning from New York.
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
We've been calling this year a tale of two markets, but there's also been a tale of two economies, especially on the consumer side.
We're also seeing a slowdown in spending. We are talking about the softening of the consumer a little bit more.
We're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective.
I think this is going to be the best earnings season in 2.5 years. Earnings are going to be healthily double-digit.
The earnings have not been terrible. Granted, maybe the market got ahead of itself, but the story around earnings, the story around U.S. exceptionalism because of these companies is still retained in my mind.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now, coming into Tuesday on a two-day winning streak on the S&P 500 on the eve of the July Federal Reserve decision. Your price action looks like this. Equity futures on the S&P 500 just a little bit firmer by 0.1%. A similar move on the Russell. Likewise on the Nasdaq. The Nasdaq at the epicenter of this market a little bit later on this afternoon as we kick off Mag 7 earnings season for the week. This is what the calendar looks like. Microsoft today, tomorrow Meta, Thursday Apple, Amazon. Lisa, this is what Savita Subramanian of Bank of America has got to say about all of this. The last 12 months were tell me, today is show me.
And that really is a reason why, when 13% of the market cap reporting just today alone, it's the reason why people are focused on whether there actually is the profitability in artificial intelligence that everybody thought there would be. Patience has run out for the promise, but not the dollars. And that, I think, is the message we've been getting.
It's investment versus monetization. That's going to be a theme we explore throughout this morning. Need to talk about the economic data as well. The first little taste of jobs data this week. The calendar for the jobs data looks a little something like this. Jobs job openings a little bit later this morning. That's the first take of the labour market for the week. Then we go through the week. We get ADP tomorrow, claims on Thursday, at least the payrolls on Friday. The earnings and the data seems to be the two big focal points away from the Federal Reserve, which most people have just assumed they know what that's going to sound and look like tomorrow afternoon.
We are data dependent.
Something like that.
We are data dependent. Keep looking at the data, which is what you just talked about, the jobs data as well as the earnings. So far, it has been a confusing picture in terms of whether it's weak or just weakening. The weakening has really won out in this sort of Goldilocks world. With the jobs data, how bad does it have to be? And this is what a lot of people have been talking about, to either bring something forward in terms of a 50 basis point rate cut in September versus a bad kind of rate cut that signifies some sort of true weakness. that even McDonald's was able to shake off. I mean, really, when you take a look at how the market has responded to sort of the warnings from companies, it hasn't been with much drama.
Are these cuts, if we get them and they start in September and we get a series of them, are they about disinflation or are they about growth or both? And that's something we need to be asking these guests throughout the morning. You mentioned McDonald's. Chris Harvey of Wells Fargo pointed this out. Just a series of quotes we've heard from corporate America over the last few weeks. The likes of McDonald's, lower income consumers are dropping out of the market. From Nike, softer traffic in North American stores. We've heard this repeatedly from a cross-section of industries over the last few weeks.
Matt Hornbach of Morgan Stanley is going to be coming up later, and he has the quote of the morning. The Olympic motto reads, faster, higher, stronger, together. It could have been used as the motto for central bank policies, inflation and growth in 2022 and 2023. Slower, lower, weaker, together seems a more appropriate description in 2024, and that is what a lot of the earnings have been pointing to. Slower, lower, weaker, together.
Can I raise you? Because I just saw this from ING. Someone just posted this on Twitter. The Eurozone economy is quite like the water quality of the Seine. Some days it may look okay, but overall it's poor enough to continuously worry about it. That right there is quite of the morning, right?
That's fantastic. If anyone doesn't know, they can sort of postponed some of the events with respect to swimming in the Seine because of water quality issues. So that is very apropos. This is confusing. You take a look at growth of the Euro region. We saw better than expected in the periphery. And guess where the disappointment came?
Germany.
That's what it has been all this year.
Yeah, negative growth. The euro just about positive. As Lisa points out, Eurozone GDP okay. Beneath the surface, though, some real division. The euro, 108.33. Let's get to the price action elsewhere. More broadly, equity futures on the S&P 500 just about positive by 1/10%. In the bond market, yields drifting lower on a 10-year for the previous 3 sessions. This morning, just about unchanged. Your yield 417.24. Coming up this hour, we'll catch up with Bob Doll of Crossmark ahead of key Mag 7 earnings. Bloomberg's Michael Shepard as expectations grow around a Trump-Harris debate. And Aditya Bahave of Bank of America as the FOMC kicks off its 2-day meeting. We begin with our top story, the growth rotation, taking a breather, going into Microsoft earnings after the closing bell. Bob Doll of Crossmark writing this. Small caps typically outperform in the early stages of economic expansions. We caution against chasing these gains at such a late stage of the cycle, even though cheap valuations may offer some cushion. Bob joins us now for more. Bob, wonderful to catch up with you, buddy, as always. Let's look ahead to the earnings later. Microsoft kicks it all off for the Mag 7 numbers that report this week. What are you looking for, and how do you gauge what investors are willing to reward and what they seemed like they want to punish over the last few weeks?
I think the bar is high for these companies, Jonathan, and they're going to have to make those numbers more likely exceed them for the stocks to be okay. People are looking for excuses to trim these names, and oh, they just reported. I own some of that. Let me trim it. I think that's the general trend in these names. Expectations high.
Dan Ives of Wedbush with even bigger expectations. He's looking for an even bigger rally in big tech. We believe this week and the rest of 2Q earnings will be a major positive catalyst for the tech sector. We expect tech stocks to be up another 15 to 20% for the year, adding to the robust tech gains in the first half of 24. Bob, what would deliver 15 to 20% upside for tech stocks? Where's that going to come from?
Therein lies the debate. We're going to have a further leg in AI. We're going to have exceeding earnings expectations, earnings estimates moving up, in my view, to get another 15 to 20%. People own these stocks. It's not like they're undiscovered. So to buy more of them, we're going to need better news that it's hard for you and me to anticipate.
We should talk about the flip side of that, which is how much more downside could there potentially be in the tech sector. John was talking about Bank of America research, saying time to show monetization. Since the first quarter, there is $9 expended in CapEx revision for every $1 in additional sales of hyperscalers. In other words, we're not seeing it translate into profits so directly. Are you seeing that as a reason to sell some of these stocks on an ongoing basis, or do you think that's been basically what's behind the declines that we've seen so far?
I think that's what's behind the declines. That doesn't mean there isn't more of that to come. To repeat, though, people have big profits in these stocks, and they see other stocks beginning to move, and so to trim these to buy some of the others, I'm not convinced that rotation is over, which generally means for a sloppy market. As we've seen this rotation here in the month of July, the market's kind of moved sidewise, as people are trying to figure all out. As you used the word earlier, it's confusing.
Yes, that's been the story of the entire year, the past couple of years. There is this issue. You said that you're not convinced that the rotation is over. The rotation has been curious because it's been marked by the companies that are most leveraged to the economic cycle at a time when we're talking about weakening, we're talking about cooling, we're talking about companies disappointing and talking about consumers that are very price sensitive. How does that make sense?
It doesn't. In my view, I agree with your set of statements and trying to square the circle. Look, people have gotten very complacent, in my view. The economy is just fine. Earnings will be good. The Fed will get inflation down to 2. I'll hold my nose and buy stocks at 22 times forward, 26 times trailing earnings. That's a hard road for me to ride.
I have to say, Bob, I think everyone wants it both ways. When inflation was up and rates were climbing, we were talking about wider margins, better margins, because they had pricing power. Doesn't the opposite apply here, Bob? That when you start to see disinflation, even more disinflation in our future, it just means a loss of pricing power, which goes back to the point you're trying to make, which ultimately is, why buy cyclicals here? Isn't that the biggest headwind to that bet?
I think that's right. And the companies are waking up to the fact that they've moved prices up and they're starting to get resistance, particularly in the mid-income consumers. And that's new over the last bunch of weeks. And that can't be sustained without more weakening. So what do? They say, we got to cut costs somewhere, and maybe we won't hire a worker or two. Maybe we'll let a worker or two go. And that's why you're starting to get some sloppiness in the employment data.
So we've got a decent idea of what you don't like, what you want to stay away from. Give us an idea of what you do like, what you're gravitating towards.
I come back to the common factors of earnings persistence, earnings predictability, and strong free cash flow. That's my defense, if you will, against the kinds of things we're talking about here. Those stocks have done fine as the market has moved up. I think they'll show their stuff even more if we get into a selling squall or some sort of sloppy sidewise action.
Is there a reason why you just are focusing on stocks? Is that just because that was the conversation, or are you just trying to avoid bonds? That stocks are both the risk factor as well as the havens factor, depending on where you go?
Only because that's the conversation. I would own some bonds here. Look, the economy is slowing. While second quarter earnings have been just fine, third and fourth quarter earnings estimate revisions have been to the downside. So the sloppiness is kicking in, and when that happens, you probably want to own a bond or two.
Which kind? Is this something that you're worried about in terms of longer term or medium term is sort of the sweet spot, or do you think that right now it's time to lock things in?
I would own quality, meaning more treasuries than corporates and high yields. Look, corporate and high yield spreads are pretty tight, as you know. And if and as the economy weakens, the questions about how long will that weakness last probably causes these very tight spreads to widen some, and therefore the govies probably outperform.
Interesting. Bob, thank you, sir. Appreciate the update. It's good to see you. Bob Dole, across Mark. You as well, sir. Big week ahead. Big week ahead full of economic data as well. I mentioned jobs numbers that come out later this week. Job openings a little bit later on this morning. Just a sneak peek of our updated survey here at Bloomberg for payrolls on Friday. The new median estimate down to 175. The previous number 206. A lot of attention being paid to what might happen with unemployment. Unemployment still expected to stick at 4.1%. Andrew Honhorst of Citi, they've got a big call. They're looking for unemployment to come up to about 4.2%. They're looking for the rate of job growth to come all the way back down to 150. And the line coming out from Andrew and the team in the last 24 hours, Lee, so the labour market is on the edge of uncomfortable. That's the view from Citi.
Other people would agree, which is the reason why it's not just Bill Dudley coming out saying, cut rates tomorrow. This is the time. Why wait? We've heard that again and again. Alan Blinder, the former Fed vice chair, came out in a Wall Street Journal op-ed yesterday, echoing what we heard from Bill Dudley, saying, why wait? I can make an argument for forward guidance wanting to be predictable, but look at all of these signs. There is no reason to hold rates at the level they currently are.
I've got that headline from the Journal piece right in front of me. The Fed should cut interest rates this week. So that's Bill Dudley, former New York Fed president. That's Alan Blinder, former vice chairman of the Federal Reserve, I believe, back in the mid-90s. That's Mohammed Al-Erin as well. Jan Hatzius of Goldman, he's not saying they will cut rates this month, but he asked the question as well, why wait? We've seen this repeatedly from quite a few big names over the last few weeks.
The flip side to the reason why they would not cut, and Alan Blinder said it's sort of, ridiculous in saying they should. They're not going to. He basically acknowledged they're probably going to do it in September, but I want to raise this prospect. they don't want to catch the market off guard. They basically have been saying, we're going to telegraph what's going to happen. We want to sort of give you a sense and make sure that forward guidance is appropriate. Is that going to alarm markets and suggest that there is something that the Fed is seeing that markets are not, especially given that the rhetoric so far has been pretty cautious and balanced?
Yeah, I think if Bill was still the New York Fed president and he put out that piece, I think this market would have been spooked. This market was spooked anyway off the back of that piece. Can you imagine if he was still a sitting Fed official?
I think he probably wouldn't have written it. I'm just saying, Bill, you can correct me.
I agree.
Maybe tomorrow. Come on.
I agree. I totally agree. What you can say when you're no longer a Fed official, very different to what you could say when you were a Fed official. Plenty more on that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The euro area economy grew more than expected in the second quarter, and GDP data out about an hour ago. Resilient expansion in key countries allowed the region to shrug off Germany's surprise contraction. GDP rose 0.3%. That was thanks to growth from France and Spain that beat estimates. Germany had a 0.1% drop. Shares of BP are rising in the European session this morning, about 1% after its second quarter earnings report. The British oil giant posted profit above analyst estimates from pumping crude, offsetting weakness in other parts of the business. BP also maintained the pace of its share buybacks and increased its dividend. And the men's triathlon has been postponed at the Paris Olympic Games, much like the European economy. It was a concern about quality. Organizers cited insufficient water levels in the Seine River. The event was originally scheduled to take place this morning. It will now run on Wednesday at 10:45 a.m. local time, right after the women's race. The weather forecast does continue to point to risks of rain and thunderstorms, which could even further delay the event. And that's your brief, John.
Danny, thank you. I heard the Italian commentary yesterday. There was an Italian TV commentator
I'm sure it
who
was.
said that the coffee at the press office was so bad in France it had been made with the water from the riverside.
All right, okay, hold up, pause. You can speak to this, actually. I'm not sure I'm going to be okay with this, or okay for saying this, but it seems like people in a certain country have a little bit of animosity toward another country.
None at all. None at all.
Or a sense of superiority.
There's clearly reasons to have a sense of superiority when it comes to Italian coffee over French coffee, no?
Sure. Okay, sure.
Right, good. We agree on that. Good.
Let's set that aside.
Up next on the programme, please, we're all on the same page. Returning to the debate stage.
I'm leading in all of the polls. I'm leading big in all of the swing states. And I say this. The answer is yes, I'll probably end up debating. I think actually the debate should take place before the votes start being cast.
That conversation is coming up next. I'm just saying that Italy does a great job of making you feel wanted in the country.
Oh, so this has something other than just coffee?
No, I'm just saying. I'm not saying that in other countries that's not the case.
It's just
that's for other people to decide. Just saying in Italy, it's just like welcome. Welcome from New York. Beautiful New York. This is Bloomberg.
It's not.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Wednesday, the Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Live from New York City, welcome to the program. 2 days of gains on the S&P 500. We might add to that. We're up 0.1% on the S&P. In the bond market, we're going nowhere. The 10-year, 417.24. Under surveillance this morning, returning to the debate stage.
I've had a lot of debates.
But you're winning on all the issues,
but, you
right?
know, I'm leading in the polls by, I think, a lot. I don't know. I hear different numbers. But I'm leading in all of the polls. I'm leading big in all of the swing states. And I say this. The answer is yes, I'll probably end up debating. I think actually the debate should take place before the votes start being cast. So the answer is yes, but I can also make a case for not doing it. I would rather run against her than him. I think she's easier than he is.
Was that answer clear? Like, kinda. Here's the latest. So we've got momentum building towards the first possible debate between Donald Trump and Kamala Harris, slated for September 10th on ABC. The Harris campaign moving forward with its search for a running mate, the shortlist including Governors Josh Shapiro and Tim Walz, and Senator Mark Kelly. Joining us now is Bloomberg's Mike Shepard. We understand Mr. Roy Cooper of North Carolina will not be in that race anymore, Mike Shepard. Can you just start there for us? Who's in the running to become the VP? Who's dropped out? And what kind of reason have we been offered?
Well, look, Jonathan, this is all moving so fast, and the campaign has very quickly had to assess up to a dozen possible contenders to be her number 2 on the ticket, and they've had to do so very quickly. 3 names, based on all of our reporting here in Washington, have really risen to the top, and you've mentioned those. Arizona Senator and former astronaut Mark Kelly, Tim Walz, the governor of Minnesota, and Pennsylvania Governor Josh Shapiro. And each of them brings a special strength to this competition for Harris. They can try to bring in some of the swing states that Harris will need to win. Pennsylvania is an essential. Whoever wins the presidency will very likely take Pennsylvania, and Josh Shapiro could flip that state back into the Democrats' column. They have been trailing there in swing state polls, including Bloomberg's, over the past several months. Arizona is another critical state, and Mark Kelly's presence on the ticket could help on the immigration issue. And then Tim Walz, that Midwestern region of Wisconsin, neighboring Wisconsin and Michigan, he could also bring some credibility there. So that is really the calculus. Pete Buttigieg has also been mentioned, especially by his supporters and fans, as somebody who could argue well for the ticket, and he sure has done so since Harris has ascended to the top of the ticket. But really, those 3 men have emerged to the front of the pack, at least where we are right now.
Can we just pick out the third name and build on that conversation just a little bit more, Mike? I think we're all quite familiar at this point with Governor Shapiro of Pennsylvania, with Senator Kelly of Arizona. It feels like, at least from here, that Governor Walz has seemed to have come into this conversation from almost nowhere. When Biden first dropped out, we had that list of names, and I didn't see Governor Walz's name on it. Where does Minnesota come into this? Why has this become a bigger part of the conversation in the last few days?
Well, it's become part of the conversation because Republicans have been targeting Minnesota as a state where they could make some inroads. They saw some softness among voters there for President Joe Biden when he was still on the ticket, and they thought that is a state we could take back. And by putting Tim Walz into play and by recognizing Minnesota as a place where we are going to hold our ground here, that also helps motivate voters in Minnesota and may also help fend off Republicans in that state. It's unclear, though, whether he has enough recognition, name recognition, that is, around the rest of the country. He is several years older than Harris, and she may want to choose somebody who is of her generation or a bit younger, too.
Okay. I was doing some research yesterday trying to answer the question, where did Tim Walz come from? And I read a couple of articles that basically he called J.D. Vance and Donald Trump weird, and that got the attention of the rest of the Democratic Party. Is that accurate?
I think that's fair to say that caught certainly caught the attention of people on the Harris campaign and elsewhere. But he also does have a sterling reputation in Minnesota. Some of the stimulus grants, they're known as Timmy's back home. And he also has a reputation as somebody who was an excellent stump speaker. He's a former teacher. He used to have lunchroom duty, as he likes to say, and is somebody who knows how to command a room. And in that sense, he does bring that element. Now, whether he ultimately ends up as the Harris choice would be really interesting to see. He would be a different pick than maybe what we're expecting here.
In the meantime, Joe Biden is still trying to govern, and this is sort of a key question. What can he actually get done? Yesterday, he came out with a series of pretty sweeping reforms for the Supreme Court. A lot of people saying that they're pretty much dead in the water. Is that accurate, or any of these reforms something that, these proposals, something that could actually take off?
It's fair to say that they're not going anywhere this year. This is more messaging to the Democratic base, especially the progressives who have hammered and clamored for this for a number of years, and especially with some of the recent revelations about the disclosure of the gifts and other goodies that have come to certain justices' way, including Supreme Court Justice Clarence Thomas. There have been calls to change the way the court is run, and also to maybe even impose some age limits. It's unusual to hear the 81-year-old president calling for those kinds of term limits, but here we are. And the president knows full well that this is not going to go anywhere in the House. We've heard Mike Johnson express his reservations, and many Republicans too, and it is the kind of hard thing to get done in any time of year, but especially with just a few months to go before the election.
Shep, wouldn't this call have just a little bit more credibility if it was made by a Liberal president at a time there was a Liberal majority?
It certainly would, because then you would see the mandate in Congress as well as the White House to really propel this through. But we are in such a narrowly divided political atmosphere here in Washington these days that doing something, even if it sounds good on paper and may have mass appeal, if you talk to many Americans, their questions and doubts about the credibility of the Supreme Court, they're pretty evident. Now, what to do about it is a different matter, and we see that on so many other really thorny issues as well, ranging from spending and taxes to the execution of foreign policy overseas. These divides are sharp and they're real, and it makes it hard to get the hard things done.
Shep, appreciate your input. Thank you, sir. Mike Shepard there down in Washington, D.C. on the latest. And just to underline what Shep had to say at the end there, the very fact that we're talking about Governor Walz is not about some kind of policy initiative. It's to your point. The word weird is more effective in campaigning than any kind of policy initiative.
Welcome to 2024. I mean, this is the reason why I have to be honest, and this is personal, and this is my personal bias. My eyes glaze over sometimes when we're not talking about policy, because it's name-calling. And as much as I enjoy name-calling, I deal with it with my children enough that I don't really feel the need.
You're going to have very glazed eyes for the next few months. You realize that, right?
Sounds like fun.
These cycles aren't changing.
I know.
Anytime soon. Coming up next on this program, we'll catch up with Tom Shapiro of GTIS Partners on the state of the housing market ahead of tomorrow's Fed decision. From New York, this is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Kicking off the week with 2 days of gains. Friday into Monday. Haven't seen that for about 2 weeks on the S&P 500. That's how choppy things have been. This morning, up by another 0.2% on the Nasdaq 100, up by 0.2% on the Russell, the small caps. A little bit of outperformance there, Lisa. Up by 1/3% going into those earnings through in the morning and into the afternoon.
What I thought was interesting yesterday was that the Russell 2000 did not outperform, which was actually notable at a time when you saw a bit of a recovery. It really came from big tech. At this point, we are seeing that reversal back to the rotation trade, but it just highlights how uncertain the lack of conviction underneath, just how much the internals are going to shift.
That's the stock market story. Let's turn the page, switch up the board and get to the bond market. The 2-year, 10-year, 30-year shaping up as follows. And we'll sit on the 10-year maturity just for a moment. 10-year yields lower for 3 consecutive sessions through yesterday. Back to levels that we haven't seen since around March time, around 4.15 yesterday. Back to about 4.17 this morning, 4.42 on a 30-year, on a 2-year about 4.39. Just for the shape of the yield curve, we'd seen this bull steepening through last week, so the front end really rallied, and then yesterday we saw a bit of a bull flattener. However way you chop it up, Lisa, ultimately the takeaway is this: the whole curve has dropped lower over the last month or so.
And it highlights how we don't really have a sense of what's going to drive it. You know how yesterday I was obsessed with the quarterly refunding announcement? Well, it came out, it was exactly the opposite as I thought it would be. And it's actually the U.S. government set to borrow less than expected, to the tune of about $740 billion versus the expected $847 billion. Why? Is this because the U.S. is doing so much better with its deficit? No, it's that basically they needed to reduce cash piles ahead of some kind of debt ceiling debate because that is required under law. So it basically just increases the chance of a default if they don't end up getting anything passed. Basically, it highlights why this is difficult to get right.
Increases the chance of a default that ultimately we probably won't see because we never do.
Correct, which is the reason why yields went lower, because they were selling less debt.
As always, the bond market making sense there for you. Switch on the board and get to foreign exchange. The euro looks like this, 108.35. If you looked at Eurozone GDP, on aggregate, Eurozone GDP was okay. If you looked at the breakdown from country to country, France, Spain, Italy, all positive. The negative, Germany. Germany has been a struggle for a while. It continues to be a struggle. The euro might be positive this morning, but Germany's got problems.
Yeah, negative 0.1% versus the expected positive 0.1% growth. This is the question for Germany. Is there anything structurally that they can do to really revive some of this growth? And frankly, reclaim the name as the engine of Europe, because right now it's anything but. And you're really seeing it in the peripheral regions with tourism, with a lot of their other types of services and goods. This is a real issue. Where is the growth going to come from, if not from Germany in a major and long-term way?
Germany was the engine of Europe, and the engine of Germany was China. And China's struggling. And companies with exposure to China, directly and indirectly, some of the luxury firms internationally are not getting that tourism, they're not getting that demand. We've seen that repeatedly. You're seeing it with some of the auto manufacturers who are struggling to compete in what must be the most competitive market on the planet in any industry, which is the EV market over in China. It's a struggle for a lot of people with exposure to that economy.
And it's unclear exactly how to deal with some of the slowdown that they're seeing. Do they more aggressively court consumers over in China? Do they open the doors to Chinese companies to come into their region to lower inflation with the hope that in return it'll be reciprocal and they'll be able to sell into China? These are all kind of angst-provoking questions in Germany at a time when a lot of people are saying that the Chinese don't play on fair ground. And Germany auto manufacturers, when you talk to them and you say, can you really say you're not going to sell into China? They will tell you, behind closed doors, that is about half our profits, if not more.
Yep.
How could we possibly do that without completely reshaping our industry?
They need that market. For sure, big time. Under surveillance this morning, some top stories for you. Earnings a little bit later. Microsoft reports after the bell today. The results expected to show strong growth in the company's cloud computing unit, with investors focused on whether the billions spent to develop AI features will pay off. It's a show me the money quarter, according to the likes of Bank of America, Savita Subramaniam. We've seen this with the likes of Alphabet. We're going to see it potentially later with Microsoft.
And Bank of America had this statistic: for every $9 added to CapEx revisions, so more than people previously expected, there was only $1 extra in sales for hyperscalers that was associated with it. So this is the issue. You're seeing the investment, but not the results. At the same time, isn't this what investment is for? Doesn't it take more than a hot second to actually come to fruition?
In an ideal world, yes, you have to wait.
So is this just basically people looking for an excuse to shed some exposure? Is this basically us creating a narrative around something? Because how many people can we get on who say, yeah, I'm disappointed, it's too late, over, story's ended?
Patience. I think we had a guest earlier this week from KKR who drew the parallel between building out the cloud business all those years ago and the same criticisms that we're hearing now about the AI business. It takes a while. And the pushback we got from Alphabet and the C-suite in the last week, they were pretty clear. Sundar Pichai came out and basically said there is a bigger risk here, under-investing in this, than the risk of over-investing. What you want to be doing here on the margin is over-invest if you need to. Certainly do not under-invest, because that will be painful in years to come.
Yeah, and people who draw the parallel to the tech boom, the internet boom of the early 2000s, it's not exactly analogous, because these companies are minting money and they're delivering profits way above what we saw from a lot of the companies back then. So they already have businesses. In terms of the transformation, there are real questions about how quickly and how dominant some of these players will and can be. I don't know that that can explain the whole story, though, given the fact that they still are exceeding expectations and minting cash.
Should we talk about the BOJ and not just the earnings? Central bank decisions coming up through this week. Two-day meeting for the Federal Reserve kicking off a little bit later this morning. The BOJ very much in focus. Details of its quantitative tightening plan, a rate decision tomorrow. A Bloomberg survey showing 14 of 48 economists predict the BOJ's board will raise interest rates. So consensus ultimately still expecting rates to remain unchanged. But there is a group of economists there who are looking for that interest rate hike tomorrow.
Yeah, and here's the issue to me that I wonder how much is baked into the market. What kind of disappointment will get played out in markets with respect to a weakening yen if the Bank of Japan does not make a move? And can the Bank of Japan offset inaction with the idea of possibly not buying as many bonds through its quantitative easing program? That, to me, really highlights how high the stakes are at a time where you are seeing some yen strength finally, which is a huge relief to authorities who have been talking about this.
A bit of weakness on the screen this morning. Yen strength over the last few weeks, that's for sure. Weakness this morning, 154.82. That currency pair higher by about 0.5%. The final story for you here, the FOMC kicking off its two-day meeting today as traders brace for a Fed decision tomorrow. The central bank widely expected to leave rates unchanged and signal a September rate cut. Tom Shapiro of GTIS Partners, a global real estate investment firm, writing this: the Fed should have enough comfort soon to start cutting rates. The worst of housing inflation may have occurred months ago. Tom joins us now for more. Tom, welcome to the program. Let's start with housing inflation, and let's start here. Provocative question, I know. How big is the spread between shelter as measured in some of these indexes that we read inflation and the real world? How big is that spread?
Yeah, thanks so much for having me. It's big. So just to put it in perspective, shelter is 1/3 of CPI. The Fed is, CPI numbers are showing up 5.2% in June. That is just not the real world. So CPI is at 3%. If you include housing CPI, it's at 1.8%. We own a lot of rental property. I can tell you that shelter is definitely not up 5.2%. It's flat to down. So why is that? So shelter really has two components. One is what's called owner's equivalent rent, and the second is actual rent. So 3/4 of the shelter component is owner's equivalent rent. So how is that determined? So they basically call people up and ask, if someone were to rent your home today, how much do you think it would rent for? Now, let me ask you a question. How many people really know the answer to that? I certainly don't. And so obviously you have a lot of miscalculation in the shelter number. So again, if you took shelter out today, we'd be below the Fed target of 2%. We'd be at 1.8%. It's definitely delayed, and there's no way that shelter costs are up 5.2%. So we'll see over the next 3 to 6 months that shelter number coming down to zero, and we'll definitely see CPI coming down to that level because of that. Because again, 1/3 of CPI is shelter.
So Tom, help us with this. Do you think we're past the cyclical bottom in real estate already? Is that behind us?
Yeah, we're already starting to see some signs of that today. Look, we've seen tremendous impact in CRE pricing. So overall valuations are down 21%. Office, of course, is the worst of that, is down about 37% to date. And that's, of course, because of the demand shock given work from home. And if you look at office in, say, San Francisco, Chicago, New York, the B buildings there are down 60, 70%. So we are already starting to see people anticipating a increase in pricing. So we're starting to see what cap rates are, which are what the investor expected yield is, already starting to come up in some of these markets. So cap rates starting to come down. So pricing is starting to come up, particularly in multifamily. So, just to give you a perspective, multifamily, you could have traded a B multifamily 3 years ago for 3.5% cap rate. Today, it went to about 5.5%. We're starting to see it come down 5.25% today. So it's really not a huge amount, but I think we're starting to see it come back. But, you also have to look beyond just interest rates. Of course, you have other factors as well. As I mentioned, you have work from home issues from the office perspective. You have expense issues. Certainly insurance has come up dramatically, taxes. Of course, wages are factoring in. So we're starting to see OpEx issues in some of our properties. So there's obviously more to it than interest rates, but interest rates are a huge component because if you had a floating rate loan, your cost of your mortgage just doubled.
And Tom, you point to particular markets that have benefited pretty dramatically during the pandemic, whether it was Florida or Texas, and how you've seen a real flattening out in terms of home price values, as well as an increase in builder incentives to bring people in to new constructions. There is a theory out there from a lot of people who join us that as soon as the Fed cuts rates, this all reverses. You start to see that pricing pressure once again reassert itself because there is just so much demand and still a chronically undersupplied housing market. Do you agree with that?
Somewhat. Interestingly, home building has been the darling, and it's gone through basically the whole downturn without unscathed. And that is, of course, because there's very limited supply, because if you have a 3.5% mortgage, you're not selling your home. So the amount of homes on the market are less than 1 million of existing homes. So that's been the issue. But there's a little bit of a double-edged sword here, because on the one hand, if interest rates get cut, it's obviously positive in the sense that it makes housing more affordable to buy. But in the other sense, you're going to see more inventory come on the market. So we are starting to see, actually, for the first time, a little bit of weakness in home building. I don't think it's going to be dramatic, but incentives, as you point out, for example, in Texas and Florida, are now at about 6.5% versus what they were at 4.8%. And mostly what the home builders are doing is they're using, basically their playbook has been to use the incentives to buy down mortgages. So if you buy an existing home, you're paying 7% on your mortgage, but through a home builder, you pay 5% because they're buying down the mortgage for you. Because people obviously look at what their monthly payments are and what they can afford. So I do think that it's not going to necessarily mean that home building is going to shoot right back up, because it's been such a dramatic really positive market for so long now. I mean, we've been seeing this for over a decade, and it's been our largest investments to date. So we're certainly not stopping investing in home building. In fact, we really like the sector a lot, but I do think we'll see a moderation a little bit.
Just to put this all together, Tom, when you first started talking about how you expect housing inflation, renter's equivalent rent in the real market as basically falling to zero at this point, or very close to it, or at least in that direction, it would argue for rate cuts, that essentially this is restrictive policy and that it's actually reducing inflation more than some people would estimate. But when you then talk further about just how much there could be renewed bout of inflation with home prices going back up as soon as the Fed cuts rates, it raises a question. Is that basically what you're arguing for, that this is basically a sufficiently de-inflationed economy, the Fed can cut rates, or is it just highlighting the dynamic and how sensitive the housing market really has gotten at this point to rates?
Well, keep in mind, home prices are not in the CPI because it's viewed as an investment. So again, it's rent that is. So just because home prices go up doesn't mean your CPI goes up at all. So I do think, again, there's going to be a little of a push-pull here in the housing market. It's been so strong, but if rates keep coming down, now I'm not talking about a 25 basis point rate cut, because who cares? But if we start seeing dramatic rate cuts, you're going to start to, you see a lot of people who actually want to sell their home, but how do you sell your home when you have a 2.5% or 3% mortgage? And that's been the real hang up here. So I'm not quite sure it's going to play out that way. I think we're going to see a pretty good housing market, probably not as good as people think it's going to be. And I don't think that means that housing prices are just going to shoot to the moon now. Again, because we're going to see supply finally coming on the market. We have the most anemic supply we've seen in decades on the market of existing homes. So I do think it's going to change, and we're going to start to see some supply on the market. So that'll counterbalance the demand side.
Hey, Tom, love this. Got to do this again soon. Let's get you in the studio. Tom Shapiro there of GTIS on the housing market and the spread between the data and the real world, which apparently, Lisa, is pretty wide.
Yeah, especially considering the fact that when somebody calls you up and asks you, what could you rent your apartment out? You're like, $1 million a month. Do you want to buy? I mean, really, at what point can people accurately assess how much they could actually get on the market?
It's like you, Mitch, inflation expectations.
I knew you were
Tell us what
that.
you think.
I knew you were thinking that. And you would totally skew it. I mean, if someone called you up and said,
totally.
What should the rent be? It depends who it's talking, if it's your person renting to you.
So excited.
Yeah.
I'm a renter. If they called me, I'd be like 20% lower than it is right now, that's for sure.
$5.
Let's get you an update on stories. We wish, right? Elsewhere this morning, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. Standard Chartered shares are gaining this morning, up nearly 6%. Earnings beat estimates, and it expanded its share buyback program. Standard Chartered will now repurchase a record $1.5 billion. It's looking to return at least $5 billion to shareholders by 2026. Shares have advanced 9% so far this year. Now, on the other side of things, Diageo is tumbling. Shares are at their lowest level in 4 years with a drop of 6.7%. The British distiller reported its first annual sales decline since the pandemic. Diageo said that customers have chosen cheaper options in markets like Latin America and still have a stockpile of spirits built up from the post-COVID era boom. The maker of Johnnie Walker does expect a challenged consumer through 2025. And Tesla is recalling 1.85 million vehicles over the risk of software failures in detecting unlatched hood. An unlatched hood could fully open, obstructing the driver's view and raising the risk of a crash. The National Highway Traffic Safety Administration says that Tesla has released an over-the-air software update to fix the issue. The impacted cars include certain Model 3, S, and X vehicles made between 2021 and 2024, plus Model Y vehicles starting in 2020. And that's your brief, John.
Yeah, that's the problem. Danny, thank you. More from Danny in about 30 minutes' time. Pretty cool that you can fix it over the air, though, right? That you don't take it in. They just send an update.
Program it not to fly up to your face.
What was it programmed to do that? Anyway, all right. More on that story later, maybe. Up next on the program, the Fed's balancing act.
The risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue. Powell has said it many times. They're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished.
Kevin Gordon was great yesterday.
He was.
Really enjoyed that. We'll get the view from Bank of America up next on the program.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. but we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond. Live from New York City, from our global headquarters. Welcome to the program. Just a flavor of the price action for you. We look like this on the S&P 500, firmer by 0.2%. Yields lower for a fourth consecutive session now. We're down about a basis point on a 10-year 416.66. Under surveillance this morning, the Fed's balancing act.
The risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue. This is the part where you try to figure out and suss out what's the actual inflation rate that they become more comfortable with. Powell has said it many times. They're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished.
Here's the latest this morning. The Fed's July meeting starting today. Investors expecting the Fed to leave rates unchanged and signal a September rate cut tomorrow. Attention also shifting to the labor market ahead of U.S. payrolls on Friday. Aditya Bave of Bank of America Global Research writing this: with smaller deviation in inflation and employment from target, the Fed's attention can be more balanced. Cuts can happen because the economy cools, because inflation slows, or both. Aditya joins us now for more. Aditya, good morning.
Morning.
Really good to see you. I know you've still got a base case of December with a little bit of a tilt towards September. Yeah. Just walk us through the base case. Why December still? And that last line in your quote, I think, is really important. This can happen because the economy cools, because inflation slows, or both. Just give us your sense of things right now.
Right. So our point right now is that September is not yet a done deal. And you can just think of that in terms of the dual mandate, right? So you look at inflation, you had 4 months, the first 4 months of the year, where inflation annualized more than 3% every single month. I'm talking about the core PCE. Then you had 2 good months, and for sure the drop in housing inflation was helpful. If that continues, I think it'll make September very close to a base case, but it was 1 month, right? And then if you look at the activity side of the data, 2.1% GDP growth over the first half of the year. That's trend-like, if not slightly above trend. The unemployment rate is a point of concern, but most other activity indicators still look pretty solid.
We should draw a distinction between what you think they will do and what others think they should do. Can we just talk about the should argument? Alan Blinder, former Fed Vice Chair, former New York Fed President Bill Dudley, Mohamed Al-Arian. We've got name after name, some big names in the world of economics saying they should be cutting this month. Do you have any sympathy with that view?
So I think if they cut this month, they would indicate a sense of panic, right? That something is fundamentally broken in the economy, and that just doesn't seem to be the case if you look at the broad data, right? Again, going back to GDP growth, 2.1%. You're adding jobs according to non-farm payrolls, roughly around trend. So this looks like an economy that's decelerated from above trend growth in the second half of last year that was never sustainable, 4%, to very much a trend-like economy. And that's the sweet spot, as Governor Waller said. And it sounds like his base case, at least as of a couple of weeks ago, was actually that they don't want to cut in September.
That said, Aditya, there's the idea of what the signal is to markets, and then there's the idea of what the policy actually does, sort of de facto to borrowing conditions, and whether it's appropriate at this point, because of slowing growth, to have a lower Fed funds rate. Are you sympathetic stripping out the market's reaction, are you sympathetic with that view that there is no need to be worried about runaway inflation or reacceleration in inflation or this idea that it's not been killed, that the genie is still out of the bottle? Are those arguments sort of gaining favor with you?
So for sure, we were much more concerned about reacceleration at the start of the year. Things look better now. That's why we still think that they do cut this year. And September is a pretty reasonable base case, right? Our point is just that it's too early to call that a done deal. If you do get, let's say you get strong payrolls on Friday, and then you get an above expectations inflation number around 25 basis points on the core PCE for August, or for July, right, in August. That's going to make the case much harder to cut in September, because why are we cutting?
I guess that the flip side of this question is how close are we to this idea of weakness rolling over to weak? This idea of some of the commentary that we're hearing from companies becoming something deeper, where basically you do see a consumer that is strapped and unable to spend more. How far away from that are we?
Again, it's difficult to tell in the early stages whether this is just a normalization or this is the economy rolling over. Our base case is that the economy is normalizing, not rolling over, with the caveat that there is some risk always that things could be rolling over. So when we look at the consumer, things seem to be, again, holding up fine, right? You look at consumer spending in the second quarter, all of the components looked okay. It wasn't just one component that was holding things up, and this was despite some issues with auto sales, for example, which are a big driver of fluctuations in consumer spending. Those were soft in June, will probably get payback in July. So overall, things look fine. They don't look super strong, but they don't look super weak either. We've had kind of an above consensus view on the consumer for a while, and we're happy to stick with that view for now.
You mentioned the payrolls report on Friday. There is a possibility that unemployment gets to about 4.2%. Right. That is the estimate coming out of Citi. They say the labor market's on the edge of uncomfortable. Goldman Sachs offering a list of reasons as to why we shouldn't fear higher unemployment. Here's a couple. There has not been an increase in layoffs that could trigger a vicious cycle of income loss and reduced spending. And a second point they make, the Fed has 525 basis points of room to cut if necessary and no reason to hesitate. Should we be comfortable with what is increasingly looking uncomfortable in the labor market?
So what's interesting about the increase in the unemployment rate, while it certainly is a point of concern, is that some of it has come from flows from outside the labor force into unemployment rather than layoffs, as you mentioned, right? Which would be flows from employment into unemployment. So some of the increase in the unemployment rate has probably happened for good reasons. You don't want to put too much weight on that, but it is certainly a reason why we've gone from a trough of 3.4 to 4.1%, with the economy actually still growing around 2.5%, 3%, right, over the last year.
Aditya, I love this. It's good to hear from you and get the update. Aditya Barber there of Bank of America on the employment report on Friday, the Federal Reserve decision Wednesday, and why they're still sticking with December as their base case, but that could shift to September.
And this above consensus view of the consumer I thought was very interesting. The idea that when you take a look at the ongoing strength, it is pretty broad-based, and there isn't this sense of falling off a cliff. We've heard that from a lot of people. That, to me, could potentially underpin the case for why the Fed isn't missing the boat by not cutting tomorrow.
The second hour of Bloomberg Surveillance up next. Here's the lineup for you. Mona Mahajan of Edward Jones, Tyler Radke of Citi, Francisco Blanche of Bank of America, and Matt Hornbach of Morgan Stanley. All of that and more just ahead. From New York City, this is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is a Fed that is desperate to try and achieve that utopic soft landing.
Really, the Fed is going to set the tone for everybody else.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal.
The Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue.
I think this is the window. It's not going to get easier to make the inflation case in the back half of 2024.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now from New York City this morning. Good morning for our audience worldwide. Let's start with a flavor of the price action for you. Drifting higher once again for a third consecutive session on the S&P 500, up by a couple of tenths of 1% across the board here. Outperformance once more on the Russell. The small caps up by a third of 1%. Let's go through the day ahead with a little bit of purpose. We'll start with the earnings. Microsoft coming a little bit later. Then the bigger players through the week. We'll hear from Meta, Apple, and Amazon. And then for the data, the economic data, just a first taste of what the jobs data might look like through the week, with job openings coming up a little bit later this morning. But I keep hearing the voice of Mohammed Al-Arian all the time on my shoulder. I talked about this yesterday. Listen to the companies. And what are the companies telling us about the consumer right now? Never mind the economic data. Kimberly-Clark, McDonald's, Delta, Pepsi, a combination of the following: a loss of pricing power and a more choiceful consumer. And we hear the same thing again this morning.
From Procter & Gamble, the maker of Tide detergent, Pampers, diapers, and Loves, which apparently they weren't able to innovate on because of supply chain constraints. Here they show that prices increased just 1% in the period compared with a year earlier. That is the lowest increase in nearly 3 years. So again, it's this loss of pricing power and a sense that in order to keep their customers, they have run out of room to keep jacking up prices in a significant way.
This is what we hear from Chris Harvey of Wells Fargo. It's a similar story. He's pointing out the same commentary, the transcripts from the consumer-facing companies for the second quarter in 24. Nike, softer traffic in North America. McDonald's, lower-income consumers are dropping out of the market. The first sales slide from McDonald's reported yesterday since 2020. All of this is stacking up which is why the likes of Mohammed is making the point that this Federal Reserve needs to make a move. Stop taking some comfort from what you might see on Friday in the payrolls report. Listen to the companies. They're telling you things are weakening.
They're telling you that they're running out of pricing power. Some people might say this was exactly by design, and this isn't a sense of weakening. You look at Procter & Gamble shares, they're up 16% this year. You take a look at McDonald's, they rose on the day because of the promise of a $5 meal. It's not that these companies are running out of room to keep making money. And when you take a look at what everybody has said, inflation tends to, when it comes down, cause margin compression because companies are not able to raise their prices as much as some of the increases in prices that they are absorbing. So some of this is de facto by design. And so how do you parse out what was sort of expected in a healthy cooling and what isn't? And I think that, yes, listening to the companies gives you a sense things are shifting. Is it a good shifting or is it a bad one?
I think the argument that's been made currently is that inflation has come down enough that we can have an insurance cut here, and they should do that, front load it. Get early. Don't wait for the economic data to weaken. Preserve what we have. If you think about the names, though, we mentioned this 10 minutes ago. These are some big names. Mark Zandi, Moody's, Bill Dudley, former New York Fed president, Alan Blinder, former Fed vice chair, Mohammed Al-Arian. The list goes on and on and on.
They're looking at the idea that the weakening is usually not just one point in time that then stops, right? If you see a labor market that is starting to cool, there is a good chance that there is more cooling ahead because there is a delayed reaction. And they're trying to get ahead of that and saying, let's set that into motion now. When you take a look at borrowing costs, there is a time, there's lag. Remember long and variable lags we've all seemed to have forgotten about? They're worried that that's going to come to the fore in terms of how high prices are, how high rates are currently, and that it will take time when rates come lower for really work through this sort of easier monetary conditions. And you do see a tightening in financial conditions just based on some of the recent sell-off that we've seen in equities.
I went through that list and lost a name, didn't I? Missed one out. Neil, I'm sorry. Neil Dutta of Renmac. You belong on that list, sir, of course. Do you know what it's like?
Yeah, I know.
You know what
exactly.
it's like.
Get a move on.
Yeah, get a move on.
And
what about me?
Yeah.
Neil, you too. Equities right now on the S&P 500, positive by 0.2%. A little bit of a lift. We've had 2 days of this. Can we make it day 3? In the bond market, yields grinding lower for 3 sessions. Lisa, can we make it day 4? Yields dropping across the curve over the last week or so.
And it has been fueled by this idea that maybe the Treasury Department won't sell quite as many bonds as previously expected. It's also with this idea that, yes, inflation is cooling. And if you get this kind of commentary, do you get ongoing senses that the beast has been killed, which is what everybody was talking about. Today, we do get JOLTS, the job openings data at 10 a.m. Eastern. That's going to be pivotal. I mean, it used to not matter. People would say it was messy data, but now it matters quite a bit. And the more that the trajectory is significantly lower, that is the soft real-time data showing companies need less labor and they're not having trouble looking for finding it.
Then it's ADP, then it's jobless claims, and then it's payrolls on Friday. Coming up this hour, here's the lineup for you. Mona Mahajan of Edward Jones with big tech earnings on deck. We'll catch up with Francisco Blanch of Bank of America with unrest erupting in Venezuela. And Matthew Hornback of Morgan Stanley as the Fed begins its 2-day meeting. We begin with our top story. U.S. stocks looking for a 3rd straight day of gains as the rotation out of big tech takes a pause. Mona Mahajan of Edward Jones saying there's still room for value, writing this. We believe this rotation has legs, perhaps not without bumps along the way. And more broadly, we see the theme of the broadening of market leadership in both tech and non-tech sectors continuing in the back half of the year. Mona joins us now for more. Mona, how difficult is that going to be when we hear from some consumer-facing companies that say things are slow and we're losing pricing power?
Yeah, thanks, Sean. And look, this is still a scenario where we see a soft landing in the economy. So yes, we are seeing a cooling, and that is coming through not only in consumption numbers, but as you guys noted earlier, the labor market shows signs of really cooling from a position of relative strength. But perhaps the silver lining is that we are cooling, but still positive in economic growth. So we see, not the 3.5% economic growth annualized figures we saw last year, but maybe it's 1.5% to 2% going forward. But those positive numbers still mean that we are executing a soft landing in the economy. That is one of the tenets you need in place in order for markets to be supported and for that broadening of market leadership to continue. You combine that with a Fed that looks poised to cut rates and inflation that will probably continue on this bumpy path lower. Those are some of the ingredients we'd like to see in order for this broadening to continue through year end.
So underlying this, there must be an economic assumption. Do you think the unemployment rate, although it's climbed a little bit, can stabilize in the low 4s?
Yeah, it does feel like our view is that unemployment remains below 4.5%. It is interesting to note we're at 4.1%, which is already above the Fed's 4% kind of forecast for 2024. That in itself, we think, and we know the Fed has been focused on both sides of its dual mandate lately, both inflation and the labor market. We think the Fed is looking more closely at this kind of uptick in the unemployment rate, the softening in the labor market. Keep in mind, one, that will probably reinforce Jerome Powell's message on Wednesday that perhaps they're set up for a set of rate cuts in the back half of the year. But two, that wage growth figure, which is starting to cool more meaningfully, has serious implications for services inflation as well. And that's the part of inflation that's been more sticky. So a cooling in that wage growth figure across the board for companies means a large part of their cost structure may be moderating to some extent. That is a good news for services inflation in particular.
A lot of this sounds pretty rosy in terms of just the soft landing and the idea that companies are maneuvering through this and still making money. Hasn't a soft landing, though, already been fully priced in?
Yeah, I think to some extent the soft landing has been priced in. We're seeing it in economic forecasts through year end. But there's still some concern that we may slip into a recessionary environment. We're hearing more and more of that, especially as we're getting kind of consumer confidence numbers slipping. You're seeing some PMI data that is back in contraction. And so that risk of a recessionary environment is not off the table, but in our case, it's not a base case scenario. So there's some uncertainty in the marketplace. What we will say is we're getting more bouts of volatility. We had another kind of 5% correction back in mid-July, and maybe we're stabilizing through that. But as we head towards the back half of the year and we think about, election season coming up, historically there is volatility ahead of that as well. And so I do think you'll see some nerves and anxiety in the marketplace flare up. But in our view, at least what the data is telling us now is that that won't translate into something more nefarious like a bear market or a recession on the horizon, which usually leads to a bear market. And so that period of volatility, we think, is the opportunity. If you haven't yet diversified and broadened your portfolio, you will get some opportunities probably in the months ahead.
Does that mean that you think that there's going to be a reversal of some of the rotation trade and that you'll see big tech reassert itself and then you can buy everything else? Or is this the idea that some of the less loved stocks now, the tech stocks that have been down some 12% in the past couple of weeks, and you want to start buying those?
Yeah, I think it's probably a combination of both. But I think if you haven't yet, a lot of folks have kind of positioned themselves to be part of this tech AI trade. It's really been the darlings of the market for the last year and a half, really. And so only more recently have we seen that part of the market slip more meaningfully. And to some extent, a lot of investors remain underweight or at least don't have as much exposure to some of the value cyclical parts of the market that really may play some catch up and have started to play some catch up in recent weeks. We do think, though, when we look towards the back half of the year, if the theme for 2023 and the first half of this year was narrow portfolios are what will be winning, we think as we look towards the back half of this year into 2025, we think diversified portfolios is really the winning strategy. And so if you don't have exposure to one side or the other in a meaningful way, we would say, start using these periods of volatility as the opportunity to get yourself there. And keep in mind, those investors that are still kind of overweight CDs, money markets, cash-like instruments, also an opportunity to start kind of dollar cost averaging down into more strategic allocations in bonds and equities.
I do want to just run this by you. Bank of America's Savita Subramanian came out with a note, and she was talking a lot about how it's a lot of show me the money kind of moment in AI. But she also said this: valuation suggests paltry price return for the next 10 years, but dividends should contribute to healthy real total returns from here. Is that how you're viewing the world as well?
Yeah, I do think it'll be an interesting next 5 to 10 years in financial markets broadly. So, we've talked in the past about how yields, while they will likely come down, the Fed will cut rates, but we're not going back to the zero bound. So we'll probably get somewhere in, that 2.5% to 3% range on a Fed funds rate, which still means a 3 to 4% Treasury yield environment. And so in that backdrop, one, yes, valuations matter more. Dividends and value investing probably is balanced with your AI tech growth portfolios, but bonds also play a meaningful part of your portfolios. So we do think that the structure of portfolios will look a little bit different in the next 5 to 10 years. And that is actually a healthy thing, especially as you're getting closer to retirement. You're getting real income from areas like bonds, like high dividend quality players, in addition to your equity portfolios. So we do think that equity profiles overall they may soften a bit, but really a nice pickup in the other parts of the market, including bonds and dividends, to your point.
Hey, Mona, appreciate the update from you, the team. Mona Mahajan there of Edward Jones. I think we've also got to appreciate the update we're getting from corporate America. In fact, from corporations worldwide. We should go over this again. Kimberly-Clark, slower price increases. Procter & Gamble this morning, Lisa went through this, slower price increases, a loss of pricing power. We see the same thing on both sides of the Atlantic, from the airline business, from Delta United American, on the United States side of things. Over in Europe, we heard the same thing from Ryanair. Two of the biggest food and beverage companies in the world, Nestle and Pepsi, also indicating the same thing. Nestle, value-seeking behavior among consumers. Pepsi, a consumer that is more challenged. That's the last few weeks. You know, in 2 weeks' time, we'll hear from Walmart. And I wonder how much of this starts to show up in their numbers, how much better they're doing, how much business they're taking from some of the players elsewhere.
As they talk to people or they deal with customers who are trading down, who are looking for bargains, which has really been the reason why they've been able to accumulate a bigger market share. When you take a step back, there is a very clear message coming from corporate America and, frankly, corporations worldwide. A lot of consumers are getting sick of paying so much. These are some of the businesses that were raising prices by double digits. Kleenex, you're talking about toilet paper during the pandemic. Remember the hoarding of that period of time, Tide Pods, et cetera. There is a now question of, isn't this good? Isn't this kind of what we want to see to get inflation down to what we need? Or is it because, frankly, consumers are just flat out? And that, I think, it continues to be the debate and will for the foreseeable future.
They're losing pricing power. There was also this interesting note. I've mentioned Chris Harvey of Wells Fargo a few times this morning. He's asking this, whether the weakness is migrating up the income spectrum as well. It's not just the low-income consumers. Maybe it's the higher-income consumers that are pulling back too. Given what's been happening in luxury, and I know there's tons of execution problems with the likes of Gucci over at Kering, but this has been almost across the board in luxury as well.
You're hearing it on the margins, just in general. People aren't upgrading to the same degree. LVMH, we heard this from. We heard this from the likes of Gucci as well. How much do you end up with a situation where everyone is feeling this sort of impending slowdown and are going to behave as such? At the same time, Aditya Bhave of Bank of America came out and basically said, we have an above consensus consumer call, and that's what we're seeing in the data, and you're seeing that in some of the credit card receivables as well. Not clear.
The economists are still constructive. They're still looking at 175 in our survey. 175,000 jobs said to come on Friday. We'll see. The payrolls report a few days away. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on Merck shares for you, down 1.7%, flipping from gains to losses in the pre-market. It did beat profit estimates. Its blockbuster immunotherapy drug Keytruda continues to dominate the market. Sales of that cancer medicine rose 16% in the second quarter. But Merck's full-year outlook was more mixed. It did up its revenue forecast by about $200 million, but it downgraded its adjusted EPS outlook. It said the downgrade was due to one-time charges it made from acquisitions. Warren Buffett's Berkshire Hathaway cut its stake in Bank of America again, the company disclosing its third sale of shares in this month. It means it's pared its massive bet of the lender by a total of more than $3 billion this month. Still, Berkshire holds almost 962 million shares. The filing show worth about $39.5 billion at Monday's closing price. Buffett is taking profits on Bank of America, with the stock up 22% this year. And the men's triathlon has been postponed at the Paris Olympic Games. Organizers cited insufficient water quality levels in the Seine. The event, originally scheduled to take place this morning, will now run on Wednesday, 10:45 a.m. local time, right after the women's race. However, the weather forecast does point to continued risk of rain and thunderstorms, which could further delay the event. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, betting big on AI.
People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend need to just kind of take a breather. We still feel convicted that this is going to be the most powerful theme over the next couple of years.
That's the view from BlackRock. We'll get another view up next on the program, live from New York City this morning. Good morning.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Wednesday, the Fed decides.
You said summers were quiet. I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Just a really busy couple of days ahead of us. It starts with the economic data a little bit later this morning. Then after the close, we get tons of earnings through the week, and it starts with Microsoft. Equity futures right now on the S&P positive by close to 0.2%. Under surveillance this morning, betting big on AI.
People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend, but we still have an enormous amount more to go in order to really embed this technology in all of our different businesses, need to just kind of take a breather. We've been cutting tech a little bit since the peak we had in the mid-late spring, but we still feel convicted that this is going to be the most powerful theme over the next couple of years.
So here's the latest. A massive week of tech earnings kicking off after the closing bell with Microsoft. Investors waiting to see whether billions of dollars in AI spending is paying off. Tyler Radke of Citi keeping a buy rating on Microsoft with a 520 price target, but highlighting potential risks, saying an aggressive increase in CapEx spending could hurt longer-term trajectory if AI adoption is slower than expected. Tyler joins us now for more. Tyler, wonderful to catch up with you. This seems to be a bit of a theme over the last week, in fact, the last month. Can we just take a step back? What are these tech companies spending money on, and what are investors starting to lose patience with?
Yeah, good morning. Thanks for having me. So Microsoft is spending a lot in terms of their CapEx on AI. What does that include? It includes buying GPUs, buying land to build data centers, power, cooling systems, stuff that you need to operate these GPUs. Again, they are seeing enormous amounts of demand. Last quarter, they commented that their capacity was below where the underlying demand levels were. So in some ways, they can't build a lot of this stuff fast enough. What those end customers are doing, they are deploying things like Microsoft 365 Copilot. They're building a lot of these large language models to unlock value across a number of use cases across their businesses.
Tyler, you said the demand is there. The monetization effort, just walk us through that. What is the timeline for that really to ramp up just as high as, say, CapEx has done over the last year?
Yeah, so if you look last quarter, Microsoft had an enormous bookings quarter. They grew bookings close to 30% year over year. Again, total revenue is only growing about low double digits. So it's clearly they're booking revenue faster than they're actually recognizing. Again, these are from big corporate enterprise clients. This is from nation states around the world. Everyone is trying to get their hands on capacity to ultimately build use cases that involve large language models. Obviously, Microsoft has an exclusive partnership with OpenAI, which provides some of the most powerful foundational models across the space. So a lot of that is related to OpenAI, but the demand is pretty widespread.
Tyler, is it frustrating to you to try to come up with a 1 month, 2 month, 3 month price target at a time where we're talking about years-long investments in a technology that has not been fully realized in terms of its potential applications?
Yeah, so certainly our target price is a little bit further out. We take a 12-month view on target prices, but obviously when you have CapEx ramping up with this type of intensity and AI ramping up in terms of this contribution, there are a lot more uncertainties. But I think the important thing is what you're seeing from Microsoft is the valuation multiple hasn't massively expanded. We're still talking about roughly a 30 to 35 times GAAP earnings multiple. Again, that excludes stock-based compensation. So while there are additional costs that Microsoft is incurring as it relates to funding these data center projects, they are continuing to offset that with costs and efficiencies elsewhere in the business. So you're still seeing earnings grow, very nicely, and we think that can continue to support the stock. And we don't feel like things are overheated, especially relative to a historical view of valuation.
A lot of people probably are sympathetic to your view on this, particularly with respect to Microsoft. I do wonder, in the broader world of some of the software in particular that we're seeing and the investments that are being made, there is this fear or this sense that there aren't going to all be winners, right? That there have to be some winners and some losers from the AI boom, that at one point we're lifting all boats. So how do you parse through what is overvalued at a time where money is getting thrown at something that's not fully established?
Yeah, I think the truth of the matter is that we're still very, very early in this space. So as I look outside of Microsoft and software, there's been a lot of concerns. This year has been really rough for a lot of software stocks. Is AI eating software? Is AI cannibalizing other parts of IT budgets? And I think the answer is it's possible some of that's going on, but there's also other factors at play. Obviously, the beginning of the year, we saw a lot higher interest rates than we expected. We saw some budget flush in Q4, which prevented a lot of software companies from having good bookings quarters in Q1. So I do think areas, as you think about big cost centers, things like contact centers, developers, right? Those are areas where you are starting to see a lot of AI have impact. Automating code completion processes. So over time, those could have impacts on jobs and on the labor force. But it's still very early in terms of who are the outright losers within the technology space.
We will see how patient investors are willing to be a little bit later this afternoon. Tyler Radcliffe, Citi. Tyler, thank you, sir. Looking for something like 520 on Microsoft. Closed yesterday at 426. If you go through the analyst community, just doing that on the Bloomberg right now, 65 buys, 5 holds, not a single sell. Earlier this morning, I mentioned Dan Ives of Wedbush saying there could be another 15 to 20% upside for the year for some of these big tech firms. If you look at the 12-month assumptions from the south side, the return potential is 18%. That's pretty much consensus on the south side at the moment.
And if you think that big tech is going to get back to where it was at its record highs just a couple of weeks ago, that's, it's down 12% already. So there's some of your payback if you do believe that it will reassert itself.
You asked the right question. Difficult. People just not willing to be patient over something that's going to be with us for a long, long time. The road is long.
I see that with Progeny. I want to get rich quick. It's like, good luck,
You want to say anything else about that?
No, that's good.
Okay.
season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities right now on the S&P 500 firmer by 0.2%. 2 days of gains coming into Tuesday, looking to make it day 3 on the Nasdaq, up by 0.25%. In the bond market, something we haven't seen since the middle of June. 4 consecutive days of falling yields on a 10-year, just about. Down by almost a basis point on a 10-year yield this morning, 416.85. Lisa, the quarterly refunding announcement, bit of detail in the last 12 hours.
Yeah, it was about $100 billion less than people thought in terms of the total amount that was going to be borrowed over the quarter. The explanation for this, it sounds really bullish. Oh yeah, that's so good. The economy is doing so great that the U.S. government's deficit's getting better. Nope, that's not it. It basically is that there's a lot of cash. And you can't have too much cash in the coffers heading into a debt ceiling debate because that is considered padding the books. So that is the reason why some people are saying there is this sort of adjustment. Make of it what you will, but yields were a little bit lower
Some of the things you have to consider at the Treasury is just ridiculous.
I know,
it really is.
I actually really enjoyed reading about this because it's just kind of counterintuitive. It's not what you would think. Logically, you know, you would think it's because they're in a better position, but no.
The 10-year around 4.15, the 2-year around 4.40. Yields a little bit lower at the front end of the curve by a single basis point. We'll sit on Europe just for a beat, just for a moment, just for a couple of seconds. GDP out of the Eurozone, actually okay. But when you break it down, it's Italy, it's Spain, it's France, doing all right. It's Germany that's not. And this has been a story, a theme for Europe for quite a while now.
Yeah, especially because they do hinge on China. It also, we just have to keep sort of reiterating, Germany has been slammed because of their dependence on Russian oil. They've shifted gears, right? They're now including more natural gas and other products from Qatar, as well as many others. Now they're highly dependent on China at a time where there's a real question about the national security components of that. It seems like Europe is increasingly breaking away from the U.S. in terms of its approach to China, taking a slightly different stance with the latest of, you know, Giorgia Meloni even, of Italy, heading over to China for a visit about how there could be a partnership.
The German model's broken.
Yeah.
We've talked about this repeatedly, relying on the United States for security, military security, relying on China for economic security, relying on Russia for energy security. Everything about that, those 3 pillars of the German model, completely snapped in half at some point in the last few years.
Which raises the question, what will be the pillar of growth in Europe if that is ultimately going to be an ongoing story that challenges the engine of growth for so many years, which was Germany?
That's the latest on Europe. German bond yields going nowhere. 236 there on a 10-year. Under surveillance this morning, our top story, former President Donald Trump saying he expects to eventually debate Vice President Kamala Harris. Trump telling Fox News the debates should happen before early voting begins. The Harris campaign saying she will be at the September 10th debate previously scheduled for President Joe Biden. So she'll be there and he won't be because he wants it earlier. Is that where we're at now?
You started laughing because you imagine her just showing up and nobody else there. I mean, the other thing that, you know, you heard in that clip that we played earlier was Donald Trump was saying, okay, well, I can make an argument for being there. I said I'd be there. I can also make an argument for not being there, you know? So it's sort of unclear exactly what's going to happen. He wants to change the network. Either way, it does highlight we do have a very different debate stage, a very different presidential election, and really, it's a lot of throwing it up against the wall and seeing what sticks.
Yeah, this is playing into the Veep stakes conversation, though. If we just go through the 3 names that are doing the rounds at the moment, I think we've got a graphic of that. We can do it again. Senator Kelly of Arizona, Governor Shapiro of Pennsylvania, Governor Walz seems to have come from nowhere, Minnesota. I find the Senator Kelly Arizona pick interesting. Interesting for the following reasons. Only a few weeks ago when Biden was top of the ticket, Arizona was almost unthinkable. That was a hope, a wish, and a prayer. And now it's something they could actually do, given where the polls have turned over the last few weeks.
Yeah, Jeanette Lowe talking about how it was all about the Rust Belt and trying to keep the Rust Belt. Now it's about even the Sun Belt and potentially turning those states. It will be an indication of exactly where the battleground is when we do get a sense of when the vice president is. What do you think of this whole like Veep stakes thing. I mean, like we're sort of people have to, go up, pitch their case, but not too aggressively because that seems presumptive. It's kind of like, this courtship bachelorette.
I think Donald Trump wishes he'd waited a little longer, but he couldn't because of the convention, if he'd had the time. I just wonder how much the experience of the last few months are going to change elections for the next few decades. Just if you can, you push your convention really, really late. When we've done the primaries, think about the primaries in 4 years' time, however many years' time when we have to do this again. Which party's going to do it, I don't know. But when we've done it and it's completed, and they've picked a nominee, and all the delegates are behind them before we go to the convention, how many people are going to come on this program and say, I don't know, let's see how the polls go over the next few weeks. Maybe they'll change candidates.
Yeah,
maybe it gets changed again.
It's back to the future. That's how it used to be. And a lot of people would like to see it return to that, the idea of a truly an open convention. We shall see.
It feels like that's where this is all heading. Maybe that's the beginning of that. Let's turn to China. The latest on China, vowing to boost consumer spending in order to meet the country's growth target. Communist Party leaders also pledging to roll out new measures to support the economy without providing much further detail. A Bloomberg survey showing economic woes are weighing on the country's expectations for crude demand. We're starting to see this show up in commodities. We'll spend some time on this in a moment, not just in oils, but also in the likes of softs, commodities, soybeans, cocoa. We're seeing it there too. You can mention a supply story, but there's demand elements to all of this. Copper, I think it's the lowest since March this morning. All of this starting to come to the surface. Crude, the whole commodity complex, pulling lower.
I'll just throw this in as well. The idea of how they're trying to stimulate demand by cutting prices, or cutting borrowing costs, hasn't really shown signs of igniting true credit creation. It's a demand story. It is not a supply story. It is not a lack of credit story.
Balance sheet recession. They're kind of the things that need fiscal stimulus to address them. And
correct.
There doesn't seem to be a willingness to do that right now. Let's turn to the latest in Venezuela. Protests erupting in the oil-producing nation of Venezuela. Socialist leader and President Nicolás Maduro claiming victory over challenger Edmundo González following Sunday's election. The country's opposition claiming it has proof of fraud and González is the rightful winner. Joining us around the table is Francisco Blanch of Bank of America Global Research. Francisco, it's good to see you. Great to see you in the flesh here in New York.
Thank you for having me.
Let's get into this story. I'm not going to ask you about the political gyrations and what's going to happen with the vote and who should be and who shouldn't be the president. I just want to understand your understanding of the situation and what it might mean for crude supply in the months to come.
Well, so there's two elements to the Venezuela story. First, will the protests end up leading to potential disruptions, which clearly the market doesn't seem to worry about. As Lisa just pointed out, commodities are going down because it's a demand story, or a lack thereof, rather. In the case of Venezuela, I think potentially it could be a bullish factor if we get some disruptions on the supply side. But also a long-term experience, if there is a change of government in Venezuela. Remember, the opposition has run a campaign on three pillars. First, they want to reunite families. There's almost 8 million Venezuelans that have moved abroad. There's also an element of eliminating all of the price distortions that they've introduced in the economy. But very importantly, they want to privatize the oil and gas sector. So I think if we go down that route, because there's a change of government, I mean, we are getting a little too ahead of ourselves here, but if there was that change of government, you could have the unlocking of what's effectively the world's largest energy reserves. Let's not forget, Venezuela has non-conventional, but the world's largest. And again, we have so much more technology today that if that were to be the case, I mean, you could have an enormous growth in the country should that get to a point. But again, I'm not saying it's going to happen.
Granted,
we're very far.
I get all of that. This is a highly speculative conversation, and this is certainly not revealing any of your base cases or any of your calls. But I do think the scenario analysis is worth it. What is online right now from Venezuela in terms of crude, and what could be online if you do start to privatize and the world reopens?
Right, so Venezuela produced more than 3 million barrels a day of oil back in the day, so I'm going back pre-Chavez, right? So it's been on a slippery slope ever since the big strike that we had in Venezuela, in PDVSA, in 2002. In fact, the bull run in commodity markets that we saw in the 2000s kind of really kicked off with the PDVSA strike in 2002, which was basically the workers of the National Oil Company facing off against, back then, Hugo Chavez. And since then, Venezuelan production of oil has been rolling down, and particularly the last 10 years or so has really collapsed to levels, to a low of 500,000 barrels a day. And since then, we've recovered to give or take 750,000, 800,000 barrels a day. So it's a fraction of what it was. And back then, it wasn't what it could be. So again, it's the world's largest oil reserves. Think Saudi Arabia, think Canada, think Russia, if you were to get that opening, right?
So given that this is speculative, this isn't what's driving prices lower.
No.
We were talking earlier that this is essentially a story of demand. This is a story of China and a lack of demand there. How much is it broader than just a lack of demand from China?
It is broader. I mean, you guys were talking a little bit about it before with Germany. If you look at the industrial economy globally, it's doing pretty badly. We've been waiting for lower interest rates and China stimulus to get the commodity complex back on track, and none of this seemed to be coming together. You mentioned it yourself. I mean, the Communist Party leaders spent a week locked up trying to figure out what to do about the economy, and they came up with a 10 basis point cut to mortgages, which seems like, okay, maybe you need a little more than that at this point. But here's my take. I think they're all waiting for the U.S. election to play out because I think, we're just 3 months away and things could really change for China. So why use your dry powder 3 months ahead relative to when you may really need it, right? So I think one of the most challenging things for China is that not only they have an issue about how to recycle their savings, which is very visible in some other commodities like gold, right? But also China has an issue of creating creating domestic demand, and of course it has the issue of tariffs, right? Potential tariffs from the U.S., potentially from the Europeans, although that's as you pointed out, it's a bit of a different story there. But that's not really helping China. China's been historically a large exporting nation, and now it's getting hurt on the back of that.
But take a step back. Is this entirely a China story, or is this something bigger, especially at a time when we're all talking about infrastructure building in the entire developed world, and at the same time, copper prices have fallen down significantly. We've seen oil prices fall pretty consistently, even with the potential supply disruptions in the Middle East if things do become more kinetic. There's a real question here about whether we are overestimating or underestimating the slowdown in demand to build, to keep traveling.
Look, 100%. There's an issue here, is that rates are still very, very high. We don't realize, I guess, because we've kind of gotten used to like rates being 525, 550, but rates are very high. I mean, they're really, really high, and they're high because the U.S. demand story remains very strong, but the higher the U.S. rates remain, the worse it's going to be for the rest of the world. And I think China also faces higher U.S. rates, and the rest of the world faces high U.S. rates. And as I mentioned, you have this combination of high U.S. rates, which are driven mostly by the services sector, right? They're not really driven by the manufacturing sector. Manufacturers would love to have lower rates, right, in this country, and the rest of the world's kind of struggling on that too. So to me, it reminds me a little bit of what was going on back in the 90s, where you just had high U.S. rates and a very strong dollar, and that wasn't helpful for emerging markets. And I think that's the policy mix that, frankly, will likely continue post-November in one way or another. But unless we start to get lower rates, I think emerging markets are really going to start struggling here.
We've mentioned a bunch of commodities that aren't doing so well. Yeah. You mentioned one that is. You said gold.
Right.
Gold's near all-time highs. What's behind this move, and how many clients are asking you about it at the moment?
So believe it or not, gold is not as widely owned as you would expect, right? So there's a couple different elements to the gold story. There's obviously central banks, which are all buying gold in droves because they don't trust each other. The freezing of central bank assets of Russia, right, really triggered an enormous expansion in central bank gold holdings. I mean, if you look back the last 30 years, two inflection points. 2008, global financial crisis, we went from seeing central banks selling gold to net buying, and then more recently, 2022, freezing of central bank assets of Russia, suddenly big jump in central bank holdings because of that action, which, a lot of people question the legality of it. So that's one big story. Second big story is really what's going on at the retail level. Europeans are selling gold. U.S. has been selling gold, if you look at ETF holdings, but the Chinese have been buying gold. And we go back to a problem of China. They cannot recycle their savings into anything productive because they went into housing, and the housing market went bust. They went into tech, and the stock market went bust. They went into factories, and then we started throwing tariffs at China. So I guess people are like, well, will I put my money in? well, I guess the Chinese central bank is putting money in gold. Maybe I should too. And so the central bank started to slow down their gold purchases, right? Which is interesting. So I think gold, like I said, is really a story around China retail buying and central bank buying. And it just goes to show how frail the global economy is and how much fracturing we have in the global geopolitical system today.
When you say don't trust each other, do you mean don't trust the United States? Is that an important distinction?
I don't think
because I'm thinking of that diversification away from the US dollar.
Right.
Is that the important piece of this?
Well, we always hear that, but the reality of the matter is the most pounding when you look at global currency reserves in the last few years has been the euro. Because remember, the biggest buyer of euros was actually Russia, right? Because Russia sold its energy to Europe in euros, right? For the most part. So the dollar has been kind of just fine. It's been the euro, but I think generally you could say G10. You could say Western world's been facing those challenges as the world's kind of fractured geopolitically. And I think pretty much every country that is not 100% aligned with the U.S. and Europe has been veering off towards buying more gold, and that basically means every country, right? Even we've seen NATO allies like Turkey buying gold. We've seen allies of the U.S. and the U.K., Singapore buying gold. So if you look at the data, there's really broad spread gold buying.
Could do this all morning. Francisco, this was great. It's good to see you.
Thank you.
Do it again soon. Francisco Blanch there of Bank of America with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The park fire raging out of control in the Sierra Nevada foothills may have started with an act of arson. A man now in jail allegedly pushed a flaming car into a ravine. It then outran fire crews and exploded in size, becoming California's 6th biggest fire on record. Conditions have been building for years and bodes poorly for the coming months. 2 wet winters in a row covered the state in newly grown grass and brush. Then summer arrived with dry air and back-to-back heat waves, turning vegetation into fuel. Samsung is expected to report its biggest jump in net income in at least a decade. That's thanks to a major rebound in its semiconductor division. Samsung had lagged behind in that chip division. It appears, though, to be back on track, winning approval from NVIDIA to make memory chips for crucial AI services. Previously, there had been months of stumbles that allowed its smaller rival, SK Hynix, to edge Samsung out of the lead. And Amazon's Prime Video is undercutting Netflix on advertising pricing. According to the FT, Amazon is pricing its spots more cheaply than Netflix after introducing an ad-based tier to its platform 5 months ago. Amazon's arrival into the crowded battle for ad dollars alone had already forced rivals to reduce their pricing, sources told the outlet. Some executives cited Amazon's vast trove of user data, giving it an edge to serve more targeted ads. And that's your brief. John.
Danny, thank you. Up next on the program, waiting for September.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, it does sound as if they would like to cut in September and justify the market's views.
That conversation up next. You're watching Bloomberg TV.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York City, welcome to the program. Under surveillance this morning, waiting for September.
I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, you know, it does sound as if they would like to cut in September and justify the market's views. This looks like a layup in terms of meeting market expectation.
So here's the latest. The Fed's two-day meeting kicking off as markets fully price in a September rate cut. Fed Chair Jay Powell is expected to give a soft signal for a cut, even with two more inflation and job prints on deck. Matt Hornbeck at Morgan Stanley writing the following. Our base case remains for there to be 3 25 basis point cuts in 2024, starting in September through November and December. Matt joins us now for more. Matt, it's good to see you.
Nice to be here. Thanks for having me.
Great to catch up. Good to see you in person as well, Matt. Let's get straight into this. For a long time, I think you and the team have said soft landing, interest rate cut. We're looking for it to happen in September. What's been guiding that view ultimately for you and the team?
Well, ultimately, we do think monetary policy is positioned in restrictive territory, but it's all a matter of degree. There's been a lot of support for the U.S. economy coming from the federal government. Last year, we had a very large increase in the fiscal deficit, and that has ultimately fed through. There are multiplier effects. There's lags that this stimulus has had in the U.S. economy, and we're slowly coming off the boil. We're looking for a deceleration, but it's far from recession, and as a result, we think the Fed can take its time, which it has done, to begin the process of lowering rates. And now we're on the precipice of that process.
I want to push the economics view through the bond market and get the rates view from you and the team as well. Tell me if I've got this right. An argument for lower short yields, also an argument for higher long end yields at the same time, simultaneously. Is that what you're looking for?
Well, we're looking for the yield curve to steepen. So short-term interest rates coming down, longer-term interest rates maybe staying where they are, maybe going up a little bit, maybe coming down less than what we see in the very front end of the yield curve. But John, that's really more of a view on the uncertainty that exists post-general election. There's a lot of uncertainty, and it's not easy for me to see investors extending all the way out the yield curve while we're facing this tremendous amount of uncertainty, not just with respect to who wins the election or the control of Congress, but what types of policies are going to be implemented when. It's not just about fiscal stimulus, immigration policy, trade policy. It's also about when will these policies be implemented. There's a lot of uncertainty around that, and I just don't think that investors are going to feel comfortable going all the way out the yield curve until we know.
Which raises a question, especially to your motto. I quoted it earlier this morning. I love it. The Olympic motto is faster, higher, stronger, together. You think that the motto should be, well, that would have been applicable to central banks in 2022 and 2023. Now it's slower, lower, weaker, together, which is deeply inspiring. I am wondering if all the central banks are cutting at once, all things being equal, if the government wasn't sort of uncertain with respect to what policies the U.S. was going to propose, shouldn't long-term yields be significantly lower?
Well, I think ultimately that's where they will head. But there's a lot of time between now and then, and ultimately the pace does matter. If central banks only lower interest rates very, very gradually, which is something that you see in the Fed's communication device, the so-called dot plot, it's telling you, Lisa, that the Fed is going to go very, very slowly. It's not clear in that environment that long-term interest rates actually have to fall very much. But that's where the Morgan Stanley view differs. We think that the Fed is going to be lowering rates once every meeting, And when I tell that to investors, I get these wide eyes, like, wow, that's an aggressive easing cycle. And we just don't think it's very aggressive as a starting point. It's not entirely clear that I would call it an easing cycle. Remember, the Fed needs to lower rates just to keep policy where it is today in real terms.
There's a real question underpinning this call, which is, where is the ending point? We talked to Ellen Zentner that, yes, it's more aggressive in the near term, but then it ends mid-year. It ends a bit earlier in terms of that rate-cutting cycle, right? That's my ultimate question. Are we truly resetting to a higher inflation environment where the R-star is going to be naturally higher, or are we not?
I think the jury is still out on that, and Ellen is fantastic. I think her Fed call this year has been wonderful. Forecasting what's going to happen in a month is hard enough. Forecasting what's going to happen in a year is that much more difficult. I think the jury is still out. I think we can have a reasonable debate about where interest rates need to be in the medium to long term to keep economic activity running at a rate, importantly, that is conducive to 2% inflation. It's not clear to me that that rate is substantially higher than where it was before the pandemic. I would say I agree with your previous guest. Rates are very high. It's clear to me that when I look at the credit creation data coming from the Federal Reserve itself, policy is very restrictive. I'm completely on the same page as Chair Powell, Vice Chair of the FOMC, John Williams. They think policy is restrictive. Based on the data that I'm looking at, I completely agree with them.
Based on your assumptions, where's the US dollar? Politics and all of this is hard to predict, but what about the foreign exchange market? Where does that fit in?
Yeah, well, okay, you start with an easy market there, the foreign exchange market. What I would say is this, we have been biased long the dollar in our investment strategy for some time now. We haven't been pounding the table on buying the dollar against all of the relevant crosses simply because the Fed isn't super hawkish, right? It's clear that Chair Powell wants to begin the process of lowering interest rates. He's trying to figure out the exact timing. I'm not sure that's as relevant, but if he was very hawkish, it would be easier for us to propose a long dollar position against a wide variety of crosses because he would be going against the grain. Well, him and, of course, the Bank of Japan, which is on tap for later this evening as well. I would say they're not there yet. The Fed wants to begin the process of lowering rates, John, and as a result, we can't be pounding the table on being long dollars. It's just not in our ethos to do that.
Matt, it's good to see you. Thanks for dropping by.
My pleasure.
Matt Hornbeck at Morgan Stanley. Coming up in the next hour of Bloomberg Surveillance, Sinead Colton-Grant of BNY, Republican Senator Bill Hagerty of Tennessee, Tiffany Wilding of PIMCO, and Steve Rasciuto of Mizuho. From New York, this is Bloomberg.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. So how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Aman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights